this stuff. I've seen a lot of questions rolling by. Just so you know, I do not look at the text box when I'm talking. I don't want you guys messing up my chi, man. I want to roll here. I don't want to be disrupted by taking questions right in the middle. I told you guys to hold the questions till the end. Like I said, you don't listen to me anyway. So I decided to ignore the box till the end of the night, okay? It's a lot easier for me to teach the material without interruption and save the questions to the end. That's the best way to do it. Sometimes I happen to notice a question and I'm sitting down looking at the chart that happens to pertain exactly to the material and you don't understand. If I see multiple of those, I will try to take those. But as a rule, I don't like to look at the box. It messes up my flow. Okay? All right, so we talked about the daily candle. Just need to know the color. The 4-hour chart. What do you have going on? Is there 3 levels of rise? Where are you in the cycle? Are we at level 3 aggressiveness? Do we see a topping out pattern perhaps? Does it confirm on the 1 hour? Has there been 3 levels of rise? Where are we? These are the things you're looking at on the chart when you're doing your check down. Okay? Just try to get an idea of the overall direction. That's all. Where are you in the market maker trend? Real versus market maker. That's the question. Don't be afraid to trade counter trend. Is the reversal imminent? Has the market maker trend been going on for 3 days? So counter trend is the trend against the technical trend and the market maker trend because the trend's been up and you know that he's going to make his reversal. So where are you in that cycle? Am I at level 3? Is a reversal possible here? Understand that they do intraday 3 levels and a reversal back into consolidation. So yes, understand where you are. Do not be afraid to trade both directions. That is a myth that is in textbooks. You can trade both directions with great success without fear. That's what I want you to understand. Every textbook tells you that I am on crack. I assure you I don't smoke. Trade both directions without fear, off of the high and off of the low, period. In line with the market maker trend, real trend, and when the signals appear. Simple. That's it. Okay, so what am I looking for in the 15-minute trading window? I'll go slow, write these down. This is not something you want to have to go back through the recording to find. You're scanning the pairs for the proper channel size, especially when you're learning. Less than 50 pips. If the channel is blown out, observe that channel and see if there is a new consolidation zone leading up to the London session. If you see it clearly, that pair is still valid. Okay, that is not on this checklist. It should be. I will add it. If you see it clearly, the pair is still valid. You're looking for the breakout false move, right? Breakout traders chase this. The breakout false move, 3 swipes at the high-low. Sometimes it's 3 candles. Sometimes it's more. Sometimes it's 2 candles. Wait for the higher low to settle in and create consolidation. Okay, they come out of the box. 3 moves quickly to the high. They go into consolidation. Ask yourself the question, how long has he been working that level? 30 minutes? 45 minutes? Roger had one that was 2 hours and 45 minutes. If he's working that level for that amount of time, he's building positions. That's his job. Is the pattern present? What's the pattern, Steve? Half a Batman, railroad tracks, spike candle, hammer, inverted hammer. What's there? What am I seeing in line with this stuff? If these things appear, place your entry with your stop loss and take profit orders. We have scripts for the scale-ins I'll cover tomorrow. Am I scaling in, or am I just going to be a heavy lot trader? Or am I a 1-lot trader with a tight stop and a 50-pip take profit? That is your choice. That's a personal preference. Everyone likes it differently. But I promise you, when you become a master and you're picking 50 pips, you must add contracts or you must scale into your trades. You're doing yourself a disservice by not doing that. Okay? So pretty much putting together what we got. What is this method? What is the market maker system? It's a trend following system, their system, based on price action and the pattern that I've laid out for you for the last 3 days. Using very few technical tools stuff that's common that we've been trading with for a while to help us identify this. Using the intraday key levels, high of the day, low of the day, that's the key levels. If you're a support and resistance trader and you just can't let go of that, let me leave you with this. How about the high of the day as the strongest resistance there ever was? How about the low of the day as the strongest support that there ever was? Add to that the timings, the session coordinated timings in line with these things when these moves are supposed to happen, and you might as well back up the Brinks truck to your back door because you got this. Okay? We need to have a systematic approach to our trading. Some way to bring uniformity to what you're doing every day. You need to stay organized and focused. You need to funnel down through the pairs and find the best picks of the day. You've got to develop some type of discipline. If I gave you the impression that I'm just pulling the trigger or wear a mouse between my legs, around my neck, you've got to have discipline in the business. This is one of the things that very few people that get to the next level have. Discipline is very important. You see the leg break to the high and you go, oh, I've seen it go up there, I'm going to take that short, and it doesn't give you any confirmation. That's not what I want you to do. I want you to take, if your discipline is second leg formation, M or W, then that needs to be your discipline. You only take those trades. Okay, there's, I think Lauren out in California, I gave her 2 pins to the mayonnaise. That's her specialty trade. That's one of my favorite trades, by the way. I will cover it. 2 pins to the mayonnaise is a false crossover move tricked by the market maker that makes everyone go the wrong way, and then he snatches it away from them. I'll show you that trade. Pick your bread and butter trade. Is it 2 pins to the high or low inside the red box going into the U.S. session? If you're a morning person and those hours work for you, then that's your trade. But have the discipline to take that trade and only take those trades and learn how those trades are structured. Get the timings down with each pair, and develop the discipline necessary to be successful in this business. Okay, a lot of you already have this work ethic or this discipline. You just were missing this puzzle. So for you guys, you're going to hit it out of the park starting tomorrow. I understand that. But most of you don't have this, and I'm trying to get everyone to come together and be on the same page. So that's the nature of this chart, or this slide. Okay, we're not going to do questions. We're going to keep rolling. This is for my live stuff. These slides are in here. No, we already had a break. Sorry. All right. Market conditions. There's only 3 market conditions that I've been talking about since I got here. That's it. 3. This is all they have. Consolidation / accumulation, stop, hunt, trend. You need to identify these market conditions, know where you are in the cycle, and trade. That's it. Simple. Okay? Consolidation, accumulation. Anticipate the stop hunt. Asian range, Gloria, blue box. No, I'm not trading that. I'm anticipating the stop hunt. They're trading between the high and low, and I'm expecting them to make the run at the stops. Okay? Stop hunt, when it shows 3 swipes at the high or low, or it comes out of the box aggressively, I know that I'm in the stop hunt part of the market cycle. I'm waiting for the signal now or the setup. I still haven't done anything. Now the trend starts to set up. The stop hunt comes to rest. They go into consolidation. I know where I am in the cycle. The trend starts to develop. Half a Batman, railroad tracks to the high, 2 pins to the mayonnaise. Now I trade. Now my job is to either limit up at 50 or count the levels and maximize my gain. When I become proficient in that, now I'm going to scale in on the aggregate and choke these guys out and take my money back that they took from me for the last 10 years or 6 years or whatever it was that you've been trading and have not had the success that you deserve. Okay? That is it. This is all you do in this business. And this is all on the 15-minute chart after the check down is done. Okay, so some breakdown of the components that are on the chart. Simple. Moving averages, M and W formations, pivot points, and TDI. Steve, can it really be that simple? Just those handful of indicators to be successful? Yes, that is all you need. Let's break these components down place them on the chart, and help you start putting this puzzle together so you can have the success that you deserve. Okay? Moving averages. A lot of you people know this. This is redundant. And if I offend you with my elementaryism, I'm sorry. But we have to cover this for everyone so we're all on the same page. What's so great about moving averages? They give you a true reading of the market direction. Do they really, Steve? When viewed in the proper context along with the market maker pattern, they can help guide you. They offer a true reading of momentum. When price dances outside, you know that it's moving. It has acceleration and momentum. Yes. They offer reliable entry and exit signals in the proper context of the market. Not in the textbook context, right? Not when they say, oh, trade a moving average crossover. No. But in the proper context of what I'm talking about, this stuff helps you make a confirmation about the stuff that I am talking about. Okay? The moving averages become moving support and resistance points, textbook or technical, but they help give us targets. I told you that when you're taking the reversal in New York after a big run, the watermark is the first target. Mayonnaise is the second. Well, that's the moving averages. So yeah, those technicals help us have targets. Why does it act funny around those? It's one of those self-fulfilling prophecies. So many people trade them, so it's so. No. Market makers know that people behave certain ways around those price points, so they act accordingly. Sometimes they bounce off of there, sometimes they break, sometimes they cross over, sometimes they don't. What's the difference, Steve? The difference is how the contracts are spread out when they get to that zone. You'll notice sometimes when it hits an average, it bounces right off. Okay? That was a fake out move. On a 5-minute chart, you probably had the crossover. On a 15, you don't. It bounces off. Sometimes you get a pin past that. What does that show you? It shows you a fake crossover. That is what they are doing at those price points. That's why we use those for targets. The 200 is like a magnet. It always works its way back there. So if you get 2 pins high to the mayonnaise on the 3rd level rise, you're a seller. Even if it crosses over the mayonnaise. You know better. That is not a crossover trade. That's a reversal, market maker style. Okay? Really, I don't need to give you the definition of an EMA. You guys should know this. But there it is. You could do it on Wiki or you could look it up on whatever you feel like looking it up on. Surely you guys know this. But what's the difference between the exponential moving average? It just has more weight is placed on current price. They're a little more responsive. The settings for the class are 5, 13, 50, 200. Mustard, ketchup, water, mayonnaise. Mustard, ketchup, water, mayonnaise. That's how I remember them. That's the colors on the chart. Okay? Crossovers will offer you trade confirmation or good signals when they're viewed in the proper context. Okay? During the stop hunt, a crossover is worthless. But after it settles in, and then you get the 513 arrow to fire in line with our new trend, the market maker trend, that is added confirmation you're going in the right direction. That's what I'm talking about in the proper context. Dean's TDI will pick off divergence beautifully. One leg in the band, one leg out of the band. Shark fin high, shark fin low. I'll cover it. Blood in the water. But if you trade that break in the stop hunt, you will get crushed. In the proper context of the market, these indicators are gold. In the wrong context of the market, these indicators are detrimental to your trading account. Okay? That's what I'm talking about. The 513 are called your signal lines. The 50 EMA is the balance line, the intraday trend. And the 200 EMA is the home base or the longer term trend. I didn't invent this stuff. It's been around forever. It's in every textbook. Right? They say price always goes home. That is why the mayonnaise is like a magnet. Price always finds its way back to the mayo. Okay. Why the 200? Think about this for a minute. The 200 EMA represents the 50 EMA on the next higher time frame. What the hell are you talking about? The 200, the mayonnaise on the 15-minute chart tells you the position of the 50 EMA on the 1-hour chart. If you didn't know that, now you do. Most of you already did. Where did I come up with this? I didn't invent it. Take the 15-minute and times it by 4. It equals 1 hour. Right? Take the 200 EMA, place it on the 15-minute chart, which is 4 times less than the 1 hour time frame, or divide by 4. It tells you the position of the 1 hour 50. You guys understand? When you're looking at the 15-minute chart and you see the 200 EMA, it is telling you what price is doing on the higher time frame without looking at it. That's why you don't need to have all the charts open and have all that crap on your desk. You don't need 6 charts open. This is the 1 hour, this is the 4 hour, this is my grandmother's chart, this is my mother's chart. You don't need that stuff. All you simply need is, after your market maker assessment, where is the price going today? You look at the 15-minute chart, and you know the position of the 1 hour chart simply by looking at where the white mayonnaise line is. Simple. Some people, I know Ray coded this, and it may be on the templates, I'm not sure. Import an 800 EMA. What does that tell you? The 4 hour chart. So now think about this. I can look at one chart, a 15-minute chart, and I can tell you what the 1 hour and 4 hour look like. Why in the world would you have 27 charts open on your desktop with all the different time frames if I can look at one chart and tell you exactly what's going on in all those time frames without cluttering up my desktop and driving myself insane? That's what I'm telling you. By understanding how to read moving averages properly, you could simply understand where the price is in relation to the other time frames by how it is placed above or below the averages. Okay, and if you didn't know that, that's a nugget for you. That's how we read the charts. If you did know it, I'm sorry that I bored you. Okay, let's look at an example. See the position of the 1 hour? This is the 1 hour chart. Here's the 50. See how it's shaped and how it's moving? Well, we import this line to here and call it mayonnaise. This line is depicted by this. This is the same exact thing. So now I don't need to look at the 1 hour chart. Does everyone see that? The dark blue line, deep ocean, I don't know, I have a name for it yet. It's new, we just put it on there. Because I don't use it, but a lot of people like it. So I don't know, if you guys make some suggestions for me overnight or something. It's royal blue, so we can call it deep water, open water fishing, I don't know, we'll come up with something. Anyway, this line right here is the position of the 50 on the 1 hour chart. If everything is trading above, then I already know, I don't have to look at the 1 hour chart. I know there's a crossover. I know it's above. Understand that? Okay, now, why are these averages used? I don't know. They just used them for some reason from 20 years ago or 200 years ago. I don't know. The 50 and 200 are used by most institutions. Actually, the 50 and 200 SMAs are actually in like Barron's report, and they use it for equities, and they just adapted it to Forex. I didn't do this stuff. It's just been there. Most institutions use the 50 and 200 SMAs on a daily chart. A lot of people use them for signals. When price crosses the 200, they buy or sell. That's why market makers act funny around these. The 5 and 13, could it be a 515? Could it be a 612? Yeah, it's all the same. It just so happens to match up with Dean's TDI, and it confirms the signals on there, and it's pretty responsive. Okay? Understand this last bullet point explains all this stuff about the indicators. No indicator can replace your ability to identify the market maker pattern and count. Okay? When I put this together to teach, I can't just say, here's the pattern, have a good day. You guys will be lost. You'll think I'm crazy. I had to put it together to help you understand how to see it. Some of you, right out of the box, bam, you're nailing it, you see it, you don't need this stuff. You can sign off and come back next year and see me in Orlando because you get it already. But some of you are struggling, so I had to put this together to help you guys see it. Some people that have never traded before are lost right now. This is going to clear up the picture for you. But understand, all these averages, all the stuff that's out there, I didn't invent this stuff. I'm not taking credit for it. I'm not trying to take credit for it. But I just put it together on the chart to help all of us make the transition easier. You are the filter. You're the only one that can identify the count and the pattern and see this. Okay, let's look at how the averages follow price. Let's take price off of the chart and understand why we look at averages in the first place. Okay, now, this is the mustard without any price on there. It's kind of funny how when you look at it closely, you see the things that I've been talking about. There's a consolidation zone at level 3. Look at the erratic behavior. Look at the 1, 2, 3 bursts to the high. Look at the peak formation high. Look at the 1, 2, 3 to the low, back in the consolidation. Look at the 1, 2, 3 to the high. Hit the stops one more time, back in the consolidation. It's there. See it? It's there. Now why don't we add some ketchup on there and dirty it up a little bit. See how it pulls back, goes into consolidation in these zones? Sometimes they stay open, but understand these pullbacks represent level counts. Some people that took my class in Dubai, and they actually took the price off and trade with a line chart and using these averages to help them understand. Okay? There's the levels. Now how about the intraday balance line, the 50 EMA? When price is in the stop hunt and you take these crossovers down, this is wrong. But when you're in the market maker trend or after the stop hunt, the W forms, and you get the crossover, and you get angle and separation, and you get 3 levels of rise, understand there are signals in here in the right context of the market. This is crap right in here. This is real. Because you pair this with the market maker move. When price collapses inside the mustard and you get a crossover back towards the range, this will help you identify a signal within the red box to go short after a 3-level run. So if you're in this and you get the collapse back under the averages, trade that counter trend back into the range. And then you have a nice 3-level drop in here back in the consolidation. This will help you identify where you are. Okay? Do you see the levels? This was a 3-level drop. 2 pins to the mayonnaise. Look at the W to the mayonnaise slightly past to induce people to sell below the mayonnaise line. 1, 2, 3. Aggressive behavior seen. W forms out. Bam! Reversal right back the other way. Okay, you guys see this? It's the same exact stuff that I've been talking about in price is sometimes more visible in the average lines or the average moving average price markers. This will help you if you're struggling seeing it or don't know how to use averages. Okay, here's a nice big fat W to the mayonnaise. And then 3 huge runs to the high. 1, counter trend back to the average. 2, pull back. 3, topping out, rolling over. We are in the sell zone up here. But understand the same exact thing that I'm talking about. Comes out of consolidation, false move to the low, a big W, and a little tiny baby W right there on the mayonnaise. 2 pins to the W, 2 pins to the W. 2 pins to the mayonnaise, rise, intraday, 1, 2, 3, back. M formation back. You guys see that? It's in there. It's in the lines. Okay? There's a thing called trend acceleration. That lets you know you're coming to the end. When the averages start to fan out and if you're at level 3 or you think you're at level 3, be ready for the market maker reversal. So to help guide you to find level 3, one of the biggest complaints that I have is that they don't understand how to find level 3. I can tell you that it's easier to identify what you think is level 3 and count backwards than to try to count forward. Okay, write it down. It's a neat trick. Steve, I can't find the levels. I'm halfway retarded. I don't know why I don't get it. What do? Here's the answer. Try to identify level 3. Look for the head and shoulders pattern, erratic behavior. Then count backwards to 2-1 and see if the peak formation was there, see if it's been dropping for a couple of days, and see if you are in the right cycle of the market. Are the moving averages crossed over and open? Are market makers creating the trick and showing trend acceleration to the rest of the world? Are we getting separation from those averages? Do I know that they fan these averages open with the price acceleration to get everybody excited about the up or down trend? Is that where I am? Does that look right? And the answer is yes. Level 3, the average will be fanned out with great angle and separation. That helps you identify where you are. The greater the angle and separation, the more likely that you are in level 3. Look for the collapse below the mustard and ketchup, and then trade back into the range. When? U.S. session, red box, London. Where are you in the cycle? Remember I told you the 3 conditions and the 3 levels. Put these things together. When price goes up, makes the high, goes into consolidation, I am in consolidation. Wait for them to hit the stops, look for the reverse. Price collapses back below the ketchup and the mustard. You're a seller back into the range. Okay? For some, the patterns are more obvious. If you want to take the candles off, it's an easy thing to do. Just go to your properties bar and remove your candles and look at these averages. It may help you, but everybody learns at a different pace, okay? This is what I'm talking about. The trend is obviously down, right? This is a down trend in every textbook I've ever seen in my entire life. Price is trading below the 50, below the 200. On the 1 hour, if I look at the 1 hour, I know it's down. It's probably down on the 4 hour. I don't have the 800 on there. But what happens? They come right out of the London Open, trigger the stops out of the blue box 25 to 50 pips lower, and then make a big sharp reversal right back into the range. If you were trading the lines, you got crushed. If you were trading my pattern, you made money. And it's not my pattern, by the way. I like to take credit for it, though. Okay, same type of thing. Price rises up. It's trading below the 50 and the 200, but we are in the stop hunt. Understand where we are. Here's the reversal. Came all the way back to 200 and went back into consolidation until the next day. Okay? Look. Here's the reversal. Came right through, pulled back. Where are we in the big overall count? Go end the day back in consolidation off of the high of the day. The pattern trumps everything. The pattern trumps everything. Okay? Here's context of the market. If you took the crossover in the stop hunt, you got crushed. You got trapped at the lower level. But if you understand the 513 giving you the signal and then the shift right through the mayonnaise and everything at the right market timing after the 1 hour consolidation, now the averages are giving you signals. Right? Then look what happens. They fan open, they run nice for the day. All of a sudden you get the inverted hammer. They shift the zone, collapse inside the mustard. If you're not out here, you need to be out here in this consolidation. It made a 100 pip run through the hammer upside down at the high of the day, getting ready to go into the red box. Comes right back to the mayonnaise like a magnet. Fakes people out to go short on the new crossover, then snatches it away and ends the day in consolidation. If you got in here and did not get out here or here, shame on you. You should have got in here, got out here, reversed back to here, and got out between the watered down mayonnaise lines. Right in here, sideways. Price rattled around in there perfectly. You had all this time to get out on the reversal. So there's 100 pips for you and about another 50. Why? Here's a 100 pip run. They come right back to the 50% fib. Okay? Right into the middle of the range and rattle around. And right before they get out, they've got to fake everybody out with the inverted hammer and show a crossover. People that come in and think that's going to continue down, ends the day back in consolidation right in here. That's what I'm talking about. The averages gave you a good depiction. There's not one close inside the mustard until here, the end of the cycle. The averages gave you a good depiction. There was still energy in that trade, momentum, right? But down here, it's bullshit. If you fell for that, because you don't understand the pattern. This is 3 swipes to the low, consolidate, then the crossover comes. Then the shift right through the high, the Asian range, and the mayonnaise water in 513. It crosses everything in one swipe. That is the pattern. moving the averages. But you understand that now you have good trend signals because you know you're going the right way. There's angle separation, angle separation, angle separation. Inverted hammer to the high, collapse inside the mustard. I'm looking for the exit reversal. Exit and enter right here, back into the range. Time with the U.S. session. When I see that spike below the man, I don't get a close, it's over or it's over here. Exit your trades in the consolidation. If I told you to deal in the consolidation, why wouldn't you exit in the consolidation? If the W or the stop hunt is the entry, then the M or the inverted hammer half of Batman is the exit. And the re-entry back into the range. Trade both ways without fear. Use these averages as a guide in the proper context of the market, otherwise they are worthless. Okay? Since we trade with two higher time frames than our entry window, what did I say? We get our direction from the 4-hour and the 1-hour. It's helpful to understand the 200 on the higher time frames brought into the 15-minute chart represent those charts themselves. Okay? That's confusing? Me too, I'm confused as hell. Just simply understand that I'm looking at all three charts on one 15-minute chart by importing in the higher or larger exponential moving averages. That's all I'm telling you. Okay? Like I said, so just looking at the 15-minute chart, we can tell where we are, where price is trading on the 1-hour chart. Once we do our initial check down, it's not necessary to look at all those charts. I've seen people that have 75 monitors, 367 charts, and I go, how's your trading going? Well, that's why I'm here in your class, Steve. Well, I can tell you right now, get rid of all that clutter off your desktop, and I promise you immediately you're going to start making money. Just get rid of all that crap on there. You don't need all that stuff open. Some guys like to have, like, I don't know, maybe they got like astronaut in their blood or something. They like to have mission control. I'm guilty of that. I see myself. I got 10 screens. But after I do my checkdowns, I close that stuff and I just focus on my monitors in front of me. And I only bring in the 15-minute charts. You don't need all that stuff. It feels good as, you know, like a man, the man cave with 37 screens and the LCD TVs, one in the bathroom, a refrigerator under the desk. I understand the man cave thing. I get it. But for trading, it's just going to confuse you and mess you up. You're not going to see the signals. If your trades or your charts are all squished down, how are you going to see the W? It's going to look flat. How are you going to see the M if your charts are all squished down because you got 35 of them? Okay, you need to have it spread out. Make your picks on a couple of pairs, and then look for the M's and W's in line with the buys that you already had. If it comes out and goes the wrong way against what you thought, don't do it. Don't trade that. All right? The M and W. Been talking about since I got here. Let's act. I gave you the anatomy of it. Let's do it one more time. What does the M and W mean? How are they formed? What's the trading psychology behind it? It's a trap move by the market maker. Okay? I didn't invent this. It's a 1, 2, 3 setup. Right? Isn't it? Look in the textbook. But no one ever could explain to me, besides the market maker, what a 1, 2, 3 setup meant, why it occurred, and what the hell was going on when it happened. Okay? The technically correct entry had you getting in about 40 or 50 pips off of the move. I can tell you right now, you're entirely too late to the party if you're waiting for the technically correct entry. Our entry as a group is right where that says second leg M or W formation. There's your answer to that question, by the way. What the hell does the second leg look like? There it is. Second leg M or W and the pattern appears. Can the right leg be higher than the previous leg? Ideally, no. It needs to be equal to or less than the previous leg, the left leg. But it's how they handle that right leg that means everything. If they throw the extra stop hunt or the needle above that right leg and then come right back below and you get the close below the first leg, the high of the day has technically changed. But what they're doing is triggering the stop of the people that traded outside that range in the right direction and the people that put pendings there for the breakouts. So that's why sometimes the second leg will throw the spike. If you're about to trade a second leg trade and they cut the high or low one more time and then they come right back below it, the TDI will be divergent, MACD will be divergent. But you know better than those indicators. You understand they threw the stop hunt one more time to trigger those traders. When that candle closes back below the leg, the left leg, that is a sign for you that you have got this and you don't have to worry about your stop getting hit. Why? It costs money to move the market. They went up there and got what they needed. They closed right back below aggressively. The reversal is imminent. It will reverse and the bottom will fall out of it, or the top, depending on which way you're going. Okay? So now, if the second leg breaks the left leg, or if the right leg breaks the left leg, now you have to analyze how that leg was broken. If they close above or below with a nice swipe, now you're looking for 25 to 50 pips lower into the drop zone. Next level strike zone, right? 25, 50 pips lower depending on the pair. To the next level stop hunt, then you look for the W to form out, or the outside pin to the low consolidation after Batman reversal. That's what you're looking for. So when you're analyzing these W's, I gave the anatomy of a W, how it's supposed to form out, right? It's variations on the theme each and every time. Sometimes it's so ridiculous it's not even funny, like the one in GBP that everyone took with Kim. If that wasn't a gift from God right before Christmas, nothing was. That was the perfect W. That would be on the chalkboard in penmanship class was such a perfect W. That's what I'm talking about, to be selective. Wait for those. The problem is you lose patience, and you think those aren't going to appear, and then damn, as soon as you take something, it makes the second leg, and you're like, if I just would have waited 45 more minutes, I would have had the best possible pull today. My stop could have been 2.7 pips. That's the stuff I'm talking about. This is what means for the W and M setup. It's a 1, 2, 3 pattern. I didn't invent it. It's in every textbook, but no one has ever explained it to me like I've explained it to you here, other than the market maker. That's what's going on when these patterns present. They're trap moves by the market maker to trap the traders at the higher levels or lower levels, repeat the level to validate the patterns, trigger the breakout, open the spread, absorb those orders, and take the money. That's what they're for. Understand this will set up for around 30 to 90 minutes, up to 2 hours. Roger showed us one for 2 hours and 45 minutes. Remember I told you if you catch second leg, your timer's 2 hours? Well, guess what? Roger was down 8 pips for about 15 minutes. Think about that. The drawdown was 8 pips for 15 minutes. Can you imagine when you pull the trigger on a trade, you're down the spread plus a little slippage or a couple of pips for about 15, 20 minutes, and on the next candle they shift the zone and you're in profit? That's what second leg trading will do for you. The entry that I have listed right here will give you that. That's what I want for you guys. Okay? You start the timer second leg. If it goes over 2 hours, something else has happened. The contracts have not laid out right. If this leg goes over 2 hours, something is wrong. Squash yourself, take a scratch, and look for another setup. Here it is. Look at that. That's exactly what I'm talking about. 1, 2, 3 to the low. 1, 2, sideways, 3 to the low. 3 to the low, pull off quickly, come back, there's your spinning top, doji, indecision candle. Guess what? They're decided. It ain't their indecision. Look at the W in the RSI. It matches the W on the chart exactly. Okay? This is the 1, 2, 3 pattern. See the hump in the middle? When this candle closes above here and opens here, this is the technically correct entry by every single textbook that explains 1, 2, 3 patterns. If you get in there, you suck. You missed it. I don't want you in there. I want you in where I'm showing the entry. As soon as that doji spinning top thing closes, I want you all in right here with 50 standards right there. Think about that. Your stop can be 7 pips. If that's Euro 2, it could be 9 pips. If you pull the trigger that close to the low of the day, you can take 50 standards. With a 7 to 10 pip stop loss, and in 2 bars, you probably make $25,000. Look how those bars switched out quickly off of the low. Okay? You're talking about 30 minutes to a small Toyota. 2 bars. Okay? As soon as that doji closes and this candle opens, this is the entry. That's the candle that makes the signal. Price is divergent. Look, straight across, this is up. This leg means it has higher closes. Okay? As soon as this little spinning toppy thing closes, 1, 2, 3 to the low. They pull back. They hit it again. They don't break it. As soon as that thing closes, you are a buyer right here against the prevailing trend. You are in. When that shifts the zone right off of the low in this big swipe, the 25 pip candle that they pull and trap all the lower level shorts at, you're in the money. You're in the money. Move to break even. Try to get 50 or try to get 250. Your call. Okay. The New York session reversal. I've been talking about it since I got here. No different. Here's the pattern, no boxes. Consolidation, 1, 2, 3 to the high. Spinning toppy thingy. Indecision. Nope, they know where they're going. Down. The bottom falls out of the trade. Drops all night between 9 and 11. Coincide with the equities market. They make the reversal. They go into consolidation and hit it again, right to the watermark, and end the day. That's the reversal trade. Okay? Typical M formation. Okay? This is what I'm talking about when they go slightly above or spike high. Here's the high. This went ever so slightly right above that high. Just enough to trigger the traders and hit the stops on the other side of the initial high. But notice what happened. They closed all the way down here. All the way down here is the close, way below that previous high. This is still a valid M pattern, and you should be a seller in here. It just so happened that the 513 crossed about the same time. As soon as this closes back below, this is going on for several hours. This is a 1, 2, 3, 4, 1 hour, 1, 2, 3, 4, 2 hour, 2 hour and 45-minute ordeal. Okay, that's pretty close to what Roger saw last night. When that candle goes back and taps the high and comes right back below, what did they just do? Steve, they hit the stops of the long holders, they absorbed the pendings, they wiped out everybody that was going the wrong way, they pretty much cleared the board in their favor. When you see that, that is the signal that the second leg is completed. You can take that trade with 100 standards and not have any fear, because your stop loss can be right there, right above that peak formation high, and you know it's going to pay out. And I could show you right here, in 3 bars you were in the money big. There's your shift bar right off of there. When that shift comes and you're in the right direction, man, I think one of the girls in my, I want to say Feeney's class said that's the best feeling in the world, and we had an argument. I said there's probably one other feeling better than that. You guys use your imagination, but when that candle shifts in your favor off the high, and you got a bunch of lots on there, and you're up big, it is a pretty damn good feeling. That's what I want you guys to see and identify. That's how you trade that. Same thing on the W. Variations on the theme. Do you see 1, 2, 3 to the low? Do you see a burst, a pullback, a burst, consolidation, a burst to the low? Pull back quickly, consolidate, second leg formation. You are a buyer in the consolidation zone when they hold for 2 hours and fail to break the low. Okay. All patterns are a variation of M and W. Flags, wedges, pennants, triangles, head and shoulders, sorry. All are simple takes on traps by the market maker. I talked about this the other day. As far as I'm concerned, they are worthless and offer a 50-50 winning percentage, unless you understand what's going on. Just simply understand that where price is in relation to the high and low of the day, you'll be successful. Okay? Are they forming an M or a flag at the high? Then the flag works out in your favor, breaks to the downside because you just happen to get it. But I showed you that they bring it in to form these wedges and these pennants and these flags. They are not trend continuation patterns. That's what they say in the textbook. But if they form a wedge or half a Batman, it looks like a pennant at the high of the day, that is not going to continue long. It's going to reverse. But what are they going to do? They're going to break upside. Remember the head fake in Forex? There's no head fake in Forex. It's a stop hunt. Okay, here we go. Remember I said the head and shoulders develops in level 3 to help you understand where you are. Triangles, variations on N and W. The patterns are a waste of time. These are a waste of time. I know people that trade them and argue with me all the time, and I ask them how their trading is, and then that's the end of the conversation. Okay, how's everybody doing? You tired? Need a break? It's almost 10. I went way over. I was going to take some questions. I guess we could stop here and cover pivots tomorrow. This way you can absorb some of this information. Would that be okay? Some of you guys saying I'm too quick, you're asleep, someone fell asleep back there. I hear snoring on an open mic. Just kidding. Okay, it's kind of mixed. How about we do this? You know what? I keep forgetting. Some people are on the other side of the world and they're exhausted. I forgot about that. And I said the hours until 10 o'clock. I got to be fair to everybody. The people that need to go to bed, go ahead. The ones that want to stay and hang around for questions, that's fine. Don't forget the questions will be recorded, so if you leave at 10, you can come back and listen to the questions for a half hour tomorrow. Okay? I know a lot of you are in regular time zone, you're excited, I understand. But the hours are 6 to 10, and I have to be fair to everybody. Okay? So we're going to break here. I'm going to take a 5-minute break, and I'm going to come back and we're going to handle questions, okay? For about 15, 20 minutes, and we'll see how it goes. All right, break for 5. Thanks. Post your questions. A through G, post your questions. All right, that shouldn't be too bad. Should be doable. All right, that ain't working so good. It's going fast. All right. Can I repeat the... All right, here's one. Can I repeat the clues to the 3-level drop and rise? Yes. Okay. Level 3 will be erratic, up and down. The head and shoulder pattern will appear most often in this level. The averages will be open and fanned out. Price will actually be running away from the averages. You have what they call trend acceleration in a textbook. If you're not sure, count to the left, 2, 1, and see if it's a couple of days. Do I actually trade without indicators? No, the set that you have is my set. Explain the week in reverse, please. Okay. Just simply, you know the week goes Sunday, Monday, Tuesday, Wednesday, Thursday, Friday, right? We all know that growing up. The trading days are Friday, Thursday, Wednesday, Tuesday, Monday. That's the order. It's the week in reverse. The best opportunity is Thursday going into Friday. The second best is Thursday going in, Wednesday going into Thursday. That's all I meant by the week in reverse. I didn't mean to cause a stir over that. Okay, where do you place the stops on the second and third trades of a trend? Okay, you place the stop 7 to 10 pips below the consolidation zone when the next level commences. Okay, the straightaway trade will be explained. I have slides for it. If you like the chart with the moving averages only, could you put a price line on the chart? Yes, some people love that. They just took off price. Because what do they do with the price? They run it up, they run it down, they beat it back and forth to scare the hell out of you. So why not just use a line? If that makes you feel more comfortable and helps you see the patterns, then absolutely take price off and trade with a price line and the averages. That's fine. If news is coming out and I'm in something, yes, take it off. Okay? If you're in a trade, I want you to get out an hour before the news. I'll cover that, but I want you to be out an hour before the news. Especially if you're not sure where you are in the cycle. If you're not 100% sure, especially when you're learning, the news could go against you. Do market makers stay within about a 200 pip range intraday? Yes. But also, you might see 200 pip drop, then the next day 200 pip drop, and then they'll make the midweek reversal and take it all back. So what happens is, it looks like it's a monster move, but they end the week close to where they started, and maybe it's only a net change for the week of about 50 to 100 pips. So they do have limitations. They cannot destroy the world economy by just tanking it 5,000 pips. They can't do that. Okay, some people say, I don't understand the 33 trade. Another one says, I don't understand how many days in a row before the reversal 33 trade goes and how does it compare to the reversal of the week. Okay. What happens is, you can have a downtrend go for weeks and days on end in the Forex market. In fact, Euro has been rising since, I don't know, like the year 2003 or something. But understand, in that uptrend, what's going on? Monday, market makers sell to you, you're a buyer. Tuesday, market makers sell to you, you're a buyer. Wednesday, you're still a buyer. They're running out of equity. So what happens is, on the third leg of rise, they got to get some money back. They'll make the retracement against the prevailing trend for them to book a profit. They can come right back down into the range, book a profit, and the uptrend can continue. The reversal will turn back into a W and go back up. Okay, understand? The trend can continue up, but they run out of equity. So what happens is, by the third day, they're running out of money. They've made 3 levels of rise. They've given out all their money. They got to get it back. How do they get it back? If they're net short and the world is net long, the way to get it back is to turn short. They'll come back some number of pips to allow them to book a profit, and then they'll turn it over again, make a W, and go continue on with the trend. Same thing for a downtrend. That's what I'm talking about. The 33 trade is 3 days of rise, 3 levels of rise, and on the last day, you have the peak formation and 3 levels of rise or drop. So you have 3 levels of rise intraday, also with 3 levels of rise over 3 days. That is a dead-on reversal trade, period. When the signal appears on that, it's over. Sell. If it's going up, buy if it's going down. Can I show an example of how to put multiple entries? Yes, we will execute the script on a demo tomorrow. Okay, now, the other half of the board, ask me some questions. Okay, someone asked me the best 2 currencies if you're starting out. Why not trade Euro? Euro is the most widely traded pair because it has a very comfortable spread. And trade one of the commodity crosses like Australian USD or USD Canadian. I'm going to give you a matrix that I'd rather see you trade about 3 or 4 pairs. I don't want you to trade 1 or 2 pairs. Why? Because if that level is holding on that pair and you took it, that trade won't pay out and the rest of the board will be running and you'll miss. What I'd like you to do is, let's say you're trading at the London Open, you might take GBP CHF, Euro, and then maybe Australian. That gives you a mix of a non-US based cross, a US based cross, and an extra backup pair. I'll cover that, okay? Yes, every one of you has a money management algorithm in the folder that tells you, it's called Roadmap to $1 Million. It tells you the exact position size for scaling in. Okay? We're also going to cover simply how to calculate the percentage. It's very easy. When you're learning, think about this for a minute. Most textbooks tell you what? Be a 1 to 3% trader. Why? Because they don't know what the hell they're doing. If you're a 1% trader, you can be wrong 100 times before you burn your account. Right? So in order to protect their name and their system, they tell you to trade 1% of your equity. That 1% of your equity is also going to be, the other side, is going to keep you from making bigger gains. When you become proficient at hitting the 50 pips every day, you can trade a little heavier. I don't want to say what that means because it's different for everybody. You have to pick a number that you're comfortable with. But understand that trading 3 to 5% on the higher side of that grid is not uncommon for guys in my group. And scaling into that gives you further leverage advantage. We'll talk about that. Okay, you're saying that the roadmap to $1 million is not in the folder. I'll address that with Kim and make sure it's in there by tomorrow. Okay, someone is asking, is the analysis still the same depending on if you're using bar charts or candle charts? Yes, absolutely. The behaviors are the same. It's just however you see the price. If you see it better in bar charts, then absolutely use bar charts. But market makers make the same behaviors with price action, so the patterns will repeat themselves exactly on any type of chart. Okay, good question. I said set a 2-hour time limit for the trade to move a significant distance. When you start doing this, you're going to see you should be up 10, 15, 20 pips on the shift zone bar. If you're not up and that holds for a while and doesn't go after 2 hours, that trade will be a scratch. If you don't have enough breathing room, about 30 pips where you can move to break even, move your stop to break even about 30, 35 pips. If you don't have that after 2 hours, take the scratch. Does each chart have its own template? Yes, 1 hour, 4 hour, but they're all about the same. Okay, what's on there is some averages and help you see where the market maker trend is. That's all you're doing. A lot of people in California have added a bunch of stuff on there. Whatever it takes for you to see it, they got some sand spurs on there and some different things and sunflowers and whatever it takes for you to see it. I am not going to be offended if you add to my set or take away from my set. Okay, I'm not going to be offended. When Big Ben spoke and the market drop, wasn't that predictable because it was the third leg of the drop? Yes, it was predictable. Absolutely. But why do you have to trade garbage? I'm showing you, I'm giving you the keys to the city. Why do you have to worry about trading the news? You guys are unbelievable. I'm giving you the keys to the city and you're worried about, once a month when the news comes out. Don't worry about it. Okay? Okay, one of the questions is that they're having trouble identifying the levels. Sometimes it appears to be 4 or 5 levels, 6 levels. I understand that. It is not an exact science. What happens is if the contracts are straddled in such a way they have to extend the move, they extend it. And in those moves, they have to book a profit, so there will be little zones that appear to be consolidation. And you think that's a level. It is kind of like price zones. Understand that it's zones of price movement, not necessarily to coincide with consolidation. Sometimes you get a straight run. Okay? As a general rule, if you can't see it, don't make it up and don't trade it. But some of you just can't see it and you're missing everything. I understand that. That comes with practice and time going through the charts and doing the homework. I know I didn't give any homework tonight. My email inbox is slammed. And yes, everyone's telling me it's bouncing. I got to get through it. I'm sorry. But listen, what's the homework? I asked Kim to post 2 fine examples of level 3 counts. Pull that out and go and make your charts look like that. And try to mark it and make sure you see it. Okay? If you're not seeing it, that's the homework. Go back and see it. If you're still stoked and can't sleep and want to do homework, that's the homework. I'm asking that you don't mail it to me because it's bouncing anyway and I'm full. I got to get in there and finish up going through that stuff. Okay, someone's asking me about the exotics will have more levels since market makers can switch pairs to move to another pair. Not necessarily. But yes, sometimes it'll appear to be more levels because the exotics chop a lot. They have a lot of spikes. Like certain pairs throw wicks on both sides all the time. An example of that is New Zealand. It drives me nuts. I don't trade it. New Zealand USD has pins all the time on both sides, and it's very hard to see. It's not necessary to trade those, especially when you're learning. Okay, another question, thank you, Greta, is that someone that doesn't know anything about the business, how can they learn? Or what do they need to do to be prepared? The truth is they should just do basic charting stuff, learn how to work the platform, and don't cloud their mind with all this other crap that's out there. If they know nothing, they will have the edge by not being skewed or confused. How about blue cheese for the 800 Blue M? Yeah, I kind of like that. Maybe. I like blue cheese a lot too, by the way. Okay, yeah, the questions are going fast. I'm trying to keep up. I was reading one and it went. It's gone. It says something about in the slide about the 15-minute window. What does are using a backup order refer to? Nothing. I'll cover it later. Okay, someone's saying about the Forex tester. Here's the deal. I've seen the Forex tester, and I can't recommend it. Why? It messes up your timing because the candles paint faster than real time, and it doesn't give you the same feeling and the same knowledge base of what's going on. There is no substitute for screen time in live market conditions. Can't help that. Does it take longer for you to learn and trade? Yeah, it does. But I promise you that if you use that simulator that goes at like 5 times real time, it's going to mess up your timing for feeling it in real time. That's why I don't recommend it. Okay? I've been given that. I've looked at it. I've played with it. It actually messes my timing up. I don't feel right using it. The candles are too fast. Blue cheese is the work of the devil? All right, I guess we can't use blue cheese. How do you identify what phase of the daily, weekly trade cycle you are in when looking at a chart? Okay, here's how. Take the day you are in right now. Go back and try to find the lowest or highest point on the chart. Peak formation high, peak formation low. Try to fill in the levels between there. Sometimes it is so blatantly crystal clear that it's scary. The chart I posted earlier today. Let me pull it up. That to me is so crystal clear it's actually scary. That's a 15-minute chart with the 33 trades in there, with the 3-level drop intraday and the entire drop. This is so scary. Or so clear that it's scary. They put the brakes on, put the brakes on, put the brakes on, reverse. When you see it like that, trade it. When you don't, do not trade. Doing the homework will help you understand this much more clearer. Ray has made a suggestion. I can tell you that Ray took 3 weeks off of trading and went back 5 years on all the majors. He has now become a superstar in this business. Why? He did the homework. Okay, let me try to read. Can you use the 1-hour chart for swing trades? Absolutely. Good question. If you identify the peak formation high on the 1-hour chart and you're in the middle of the week or get the reversal, then why not use the 1-hour chart to monitor and move the stop into the consolidation zones? Ray made a comment. Doing the homework will show you so much that the clear ones will stand out and you won't miss them. Yes, very important. Can you start using the templates or wait for the end of the course? No, Terry, I think you should have all the stuff loaded and be looking at it exactly how we're using it now. Okay, Fred said, how about Blu-ray for the new line? There's no blue food. Okay, Joe, I see your question. What is the net effect of hitting the stops high and then hitting them low? It seems that would negate the contract imbalance the market makers are seeing. No. I understand, but there's money at every price point. When they go up high, they hit the stops. They also trap a new batch of traders that are expecting longs. So it's a two-pronged thing. It hits the stops, and it also picks up the pendings and picks up the orders that are there and turns them hot. Okay, Kim said blueberry. That's not bad. We'll vote on it in Orlando. Blue Jello, blue Smurf, blueberries. I don't know. Blue sky. Seeing all these. Blue ice. Isn't that a drug or something? Blue moon. All right, you guys are on blue crack. Okay. I'm going to wrap it up. I thought it was a pretty good session. I'm sorry I went so long. I hope you guys are getting this. Tomorrow's the last day. We got a lot to cover. We'll figure it out. Someone said bubonic plague. I don't even know if that plague is blue, is it? All right, guys. Thanks a lot. I had a great night. I enjoyed it. Don't send me any homework because it's bouncing. I got to get my email box emptied. But if you are lost and struggling, do some. Okay? And then we'll talk about it in the start tomorrow. All right, and by the way, if you weren't trading listening to me, tonight's the night you can start back up. Someone's looking at the 5-minute chart. I told you that is an absolute no-no. Stop looking at the 5-minute charts. Cut them out. There's actually a way to take the 1 and 5-minute charts off of your platform. I'll show you guys how to do it if you want. Stop using those charts. They're garbage. All right, I'm getting out of here. Good night, good night, good night, good night. Thank you all. Okay, good. Okay, I see people complaining about the sound, that I'm coming out distorted. Now you want me louder? You guys are unreal. All right, let me play with this thing here. All right, how's that? Too loud, not so loud, kind of loud. All right, good. Louder. Diet Coke for everybody. All right, man. This quote, I wanted to start with this today. You guys, I'm telling you, I don't even know how to express my gratitude, and I don't know if you guys can feel this or not, but there's something bigger going on here, bigger than all of us, bigger than me, bigger than Compass. It's just absolutely amazing. My inbox is absolutely flooded with beautiful thank yous and accolades and people full of excitement with 125, 150 pip gains, catching the high, the low, the reversals, trading back in the range, killing it, scaling in. I don't know. Ross sent me this quote today, and he just caught me at the right moment. He actually made me tear up. Ross, thank you. It's very important to think about this. When you leave this teaching and go tell people that you can make 1,000% a month, they're going to tell you you're smoking crack. It can't be done. The average successful trader averages 80 to 100% a year. One of the best traders in the world that made $200 million, a breakout trader, Russell Sands, 80 to 100% a year. There are people in this room making that a day. I saw somebody scrolled up earlier. You guys, I don't know if you could see it or not. She said she won the contest at FXDD after my teaching in 2 trades. You have no idea how stoked I am about that. It's absolutely amazing. So anyway, keep away from small-minded people. Keep away from people that don't understand what we know. They will only tear you down and tell you are crazy. Okay, I want to cover immediately some things that happened yesterday. Let me get caught up here. Okay. This is the trade of the day from yesterday. This is it. Okay? CHF, 1, 2, 3 to the low right out of the box. They pinned the low. They pulled away aggressively. They came back at the London Open right near it and missed it. That is the signal. Anywhere in those 3 green bars after the 2 pins to the low closed, you are a buyer. You have 45 minutes to make up your mind. Buy against the trend. 50's lower than the 200, 513's down and open. The trend in the rest of the world is down. You now know better. You are a buyer against that trend. There's 1, 2, 3 levels of rise all day, right through the U.S. session to just outside the red box. When they make the second leg, you take your profit for a 100-plus run and stop yourself out and reverse back into the range. If you're just so greedy, you got to have the extra 35 going the other way. If not, go to bed. Okay? This would have kept you up all night into the sunlight. But there it is. 1, hit the stops, rise. Hit the stops in 1 bar, rise again. Hit the stops, high trap, hit the stops, high trap, reverse. That is your exit signal, level 3. 1, 2, 3 levels to the high, 3 swipes towards the high, 3 pushes of energy to the high. Whatever you want to call it, there it is. That is the chart of the day. Many people got this. I think the pods sent me an example. Okay, I'm going to talk about this next. Let me get organized here. Sorry, guys. Okay, this is Roger. That's coming up. That's in there somewhere. Okay, I'll skip right to Roger. Roger, I'm picking on you, man, but I'm very, very proud of you. Roger has been around me for a few months. He was a scalper. The problem that Roger had is probably the problem a lot of you are struggling with. And I'm not picking on this guy. He's a great guy. The problem is that he had the mentality of everything in the textbook that's out there and he couldn't let it go. I think for a couple days he thought I was crazy. Okay? Let me read this to you. Steve, the light came on this morning. I mean the light in my head. He didn't mean the outside light. I finally see what you've been saying, and it's simple. Trade the high of the day and the low of the day, or both. Very important. There will always be one each in every trading day, so just wait for it. How simple can that be? There's a high every day, there's a low every day. Think. This is not Roger, I'm talking. There's a high every day and a low every single day. He finally got it. Steve, will this system fail? Will it suck one day? Will it not work? No. There's a high every single day. There's a low every single day. Guess what? There's a high every day and a low every day in every market. Commodities, futures, equities. If you understand that, you can trade anything universally. Okay? Let me pick this up. The stress of trading just left me. Roger, congratulations. You're stress-free. You will be successful in the business beyond belief. I no longer care if I get stopped out for a few pips because I now know that these few pips I lost in that last trade will be made back because there is an HOD and LOD every day. And the only problem was I didn't find it yet. I'll get in next time because there is an HOD and LOD every day. Can I say that enough? The high is every day, the low is every day. Last night I woke up at 3 a.m. Who knows why? But I did, and that's when it hit me. I went to the computer, started counting to 3. I saw a 1 and maybe a 2. Oh, yes, there's the 2. And it's going to be up for a 3. My green candle is now red and a long wick, and it closed, but do not take the trade. No, I waited because there was no pattern yet. The next candle closed, and it was red, bigger than the first. But if there was a wick on the bottom, so still no pattern. I'm asking myself, is this going to be an M or half a Batman? The third candle closed red, no wick, and the TDI and my stochastic indicators both are saying to go short. I opened the trade on the next candle at 33.27. Listen to this part. My drawdown was 4 pips. 2 of the 4 was the spread, and it lasted for 10 seconds. He cleared the spread in 10 seconds with the drawdown. The trade went on 85 pips, but I screwed up, and my first trade got closed at 41 pips. Roger, if that's a screw-up, I'll take it every day. The trade went so fast, I missed the chance to move my take profit down. All in all, the 85 pip trade gave me 432 pips because I scaled in twice. This is the second letter I'm reading to you from Roger. His gain on Wednesday was 12%, and last night was 18%, for a total take of 30% in 2 days. Now think about this for a minute. I told you that successful traders make about 80 to 100% a year. And I am not picking on anybody, please. Roger made 30% in 2 days. Think about that. Think about this compound and what it could lead to. Think about how much money you can make. Think about how you can take care of your family and how you can take care of your generations of family. This is what I'm talking about. This is the kind of stuff that just, my heart is bursting with excitement for you guys. You give your money to a manager and they make 80, 90, 100, 120% a year. You trade yourself with the knowledge that I'm giving you this week and you make 30% in 2 or 3 days. Consistently over and over again. You can pick the high and low in this market and you will be successful. Period. End of story. Any kind of torture you've had in the business, it ends this week. It's over. You should feel like Roger. You should feel a relief in your stomach. You should feel great that knowing that 2011 is going to be pretty damn good for me and my family. Thanks to Kim putting this class together. That's what you got to be thinking to yourself right now. I want you to take the next week or two off. It's the holidays. You guys should be relaxing, enjoying yourself after this, but you can't stand it, I know. I want you to go wherever church you go. Thank whoever you need to thank. I'm not picking on anyone's religion. I'm just telling you that you need to have a calmness about you. Treat yourself to a new screen or a new mouse pad or whatever you can afford to do, and start next year with a new energy and a new invigoration, a new excitement for the business. Forex is fun again, isn't it? The business is now fun. It's no fun to lose, but it's fun to win, and it's fun to beat these guys of their money. That's what I want for all of you next year. Let's break the broker in 2011. And if there's any brokers in here, I'm sorry, but we're going to break you as a group. Okay, this is from the pods. A lot of you know who they are. Great trades last night. Took 50 pips on each, plus 2 trades this morning, New York reversals, for a net growth of 13%. It was demo, but so what? 13% growth in an account in a day or two. I'm sorry, in one day. Think about that. If you don't have a lot of money for the business, who cares? A $1,000 account can grow $130 in a day. Think about the numbers. 30%, if you have a $1,000 account, that's $300. That's the difference between some people eating and not eating. That's why I'm so excited. There are people out there that are losing their jobs, that are struggling. Unemployment is cut off. They are dying on the vine out there. I'm throwing you a lifeline. I'm trying to save everybody. Trust me, open your heart and your mind. You will be successful in this business if you just trust me. Okay, I want to cover this trade. A lot of people ask me about this. I got a ton of this. Steve, you suck. GBP-CHF got stopped out. Your system's no good. I quit. Call you next year. No, that's not what happened here. They saw 1, 2, 3 to the low on GBP-CHF. The second leg formation appeared. Start your timer. What happened? First of all, the red box was appearing. Session changeover was imminent. Second of all, if you entered where this gentleman entered, I gave him the 2-hour time horizon. He should have had a small loss or scratch. He sat there like every textbook teaches you to do and says, let the market prove you wrong, and he pissed away a stop loss. Stop giving these guys your hard-earned money. It ends here and now. Make the commitment to yourself. Stop it. What happened? Contracts were built up in such a way that they needed to hit it one more time. Take a measurement from the low to the next low. Damn if it ain't 27 pips lower. What did I tell you they do? They hit the stops in 25 to 50 pip increments to trigger the stops, stun the traders, freak you out, whatever, and it worked nicely on you again. So they hit him again with railroad tracks to the low, and all he had to do was re-enter. He should have took a scratch for 5 to 7 pips and re-entered and got the 7 back plus a profit for the day. And he should have looked at other trades. He should have not focused on one pair. He got jammed up on one pair, and they made an ass out of him. Why do they do that? That's their job. That's what they do. Okay? If you don't own a clock, a stopwatch, an alarm clock, or a wristwatch, you better treat yourself to one for Christmas, because this 2-hour time limit is not negotiable. Will some of them work out? Yes. But the 2-hour time window is designed for them to straddle the contract and let them come in. That's why they wait. When the contract balance turns, they turn. This was a 50-50 proposition. I am teaching you not to be in the 50-50 business. We are in the 9 out of 10 or higher business. If that 2-hour time limit expires and you're in a trade, eat it. 5, 6, 7 pips. You will make it back on the next trade. Okay, look what they did. They triggered the stops, 27 pips lower, railroad tracks to the low at the changeover in the red box. Look at what's going on here. The trend has been down. Right? Look to the left. The trend has been down. There's actually 3 moves to the low in there. Forget about his little baby 1, 2, 3. Count from yesterday's peak formation high. You were at level 3 in the U.S. session after the stop hunt. I hope you guys are seeing this. If you were in that trade for 2 hours, you should have had maybe, I'll even be generous and say minus 15. The next trade would have made it back. Okay? This time limit or time horizon is absolutely non-negotiable. It's not something I pulled out of my, do I have to say it? You know I have a bad mouth already. This is a serious way for them to wait for the contracts to accumulate, and then they hit it the other way. They did exactly what I told you they do from time to time. The buildup was not correct. So what did they do? They hit them again, 27 pips, from low to low. I told you this was going to happen. Now you're telling me that I don't know what I'm talking about. Why did this fail? What's wrong? Your system sucks. I told you it doesn't work. Am I going to get every trade right? No. But you understand the big picture in the market. You understand what's going on. I understand that this was a demo, but it doesn't matter. I want you to treat the demo as real, because when you make the switch over, I don't want you to be nervous. You shouldn't be a cowboy in demo, and then when you go real, you get nervous and you don't trade the same. Open your demo with the same balance that you would open your reel with. Grow that demo 50, 100% before you go live. If you can't bag this stuff in demo when there's no real financial pressure on you, you are going to struggle live. Okay? I hope everybody sees this. Buy yourself a stop clock or an alarm clock or whatever you want to call it. All right, this is the trade of the day. Do you see the difference in this W? Let me point something out. The first leg down occurred late Asian, early London, late Asian. The second leg down is right about between 3 and 4 o'clock when I told you the session changeover comes. Imagine that. Those are the ideal trades. They are also 25 to 50 pips above or below the blue box. That is ideal. Do some move within the blue box? Yes. Do some stay in the same range as the blue box? Yes. Ideal trade. This is ideal. Do you see how crystal clear that is? The box is slightly blown out at 57. Redraw the consolidation zone in the last bottom quarter of the box, right around the M2 pivot. Bam, they come right out, hit it straight down like it fell off of a cliff. That is your signal for the first leg. They make the pullback, trigger the stops in both directions. They hit it again, but don't break it. They come close, they open the spread. All the signals I was telling you are there. All the pins are to the downside. Think about this. They push the candle down, pull it away. Push the candle down, pull it away. Push the candle down, pull it away. The pins are on the downside. That is a clue that they're putting on the brakes. They give you 45 minutes to make up your mind. You can think about this, go outside, walk your dog, jog around the house, get on the elliptical, drink a cup of coffee, and come back and go, pins are on the downside. Look at that, 3 candles. Hammers, nevertheless, starting to rise. This looks like a good trade. Damn, if that ain't a W. TDI is kind of divergent. Looks good, I think I'll take it. 2 bars later, the 513 arrow fires and crosses over to confirm you are still right. Then what do? They rise off of the low quickly, hit the stops high, hit the stops low. Next level is underway. The buying pressure has been relieved. Okay? Notice the pins to the top side of the first zone of stop hunt. These are stop hunts within the range. They are lightening the load to move to the next level. Hit the stops high, hit the stops low. Don't let this scare you. That's what it's supposed to do. I'm sure that these pins over here line up with some support and resistance, or in this case resistance, on the chart, if you go back probably from February 07 at 6:32 in the afternoon, there's a line that'll match up with that. I'm sure of it. Those pins validate those trades and trigger them. Okay? Hit the stops high, hit the stops low. The next level is underway. The next level goes up, and in one bar, they hit them high and hit them low. See it? One pin. Pin top, pin bottom. Clean the board, next level high. Okay? Coming out of the red box, you have 2 pins to the high. Isn't this at level 3 the same thing as this at 3? Look. This is the inverse of this. Hold this in the mirror, and that's what it is. Shoulder, head, shoulder. Okay? M formation, sell. Don't wait for the shoulder, you're late. Sell right here. Okay? And if you're still in this, exit your trade right here. Don't let this first move of them clearing the board scare you out of a trade. Okay? When this commences and breaks this level here, stop loss goes below these pins. Stop loss goes below these pins 5 to 7 pips. You are not going to get stopped out. A nice run up, you're getting into the red box. Remember what I told you? They change over at the session. Okay? So now, 9:30 equities open. They make the false move to end London. They get aggressive at level 3, hit the stops in both directions, trick the hell out of people, clean the board, lighten the load. The second leg comes back. Remember I talked about when they throw the pin, how they handle the high? When they throw the pin above the previous high. What does that do? Think. Smarter than these guys now. I know this shit. They pin and they grab those pending orders above. Steve told me they open the spread. They grab those orders. They validate the AB equals CD continuation. They validate all those trend guys because first they showed a downtrend, tricked the hell out of everybody. Then they crossed the 200. They broke through the mayonnaise. Everyone and their mother turns long. Now what do they got to do? The ones that were waiting and didn't turn long yet, they got to put the brakes on those people when they go, damn, I'm missing the uptrend. I need to hurry up and get in here. When those people get in, they apply the brakes, jam them at the top. The smart ones that went short at that level are triggered on the second pin. The second leg of the M triggers those orders. If that bar had closed above the M high on the first leg, that's a different story. That's not an M, that's a continuation. When that bar throws the pin slightly above there, the spread opens, those orders are absorbed, the ABCDs are validated, the butterflies are validated, all these people in the world that read those crappy textbooks are now validated, and they're beating themselves on the chest about how great they are, and then they watch it tank 35 pips and take out all the stops. That's what's going on. When you see that, you got it. You got it. So you bought in on the W, your exit is the M at the session changeover. If you got out on the first leg at the top of the red box, congratulations, you grabbed almost every single pip that was available to you today in a pair. Ever thought you could do that in your lifetime? It's absolutely amazing. Okay, and then for the greedy ones, I know Fred from California, I know Dick, they probably took the second leg back into the range because they can't stand it. Okay, go through the charts. The 2-hour time horizon is not negotiable. Get a nice clock on there like they use to play chess, or an alarm clock, a digital clock, whatever you need. Set an alarm on your wristwatch. Do not sit there like a moron like they teach you in the textbooks. And I'm not calling you a moron, the person that sent that in, I'm sorry. But don't sit there and let the market prove you wrong. You are smarter than the market now. The 2-hour time horizon expired. You got into the session changeover. That trade is invalid. Take a scratch and take this trade instead. Okay? Trade multiple pairs. Look for various setups, variations on the theme. If you see this W, this is similar to the W that I think happened in GBP Thursday, Friday of last week. Think about this for a minute. If you only traded twice in the last 2 weeks and took 50 or 100 lots, you'd be up about 50 grand. Is that so awful to not take a trade every day and only wait for the God's gifts of W's and M's to appear perfectly with no time horizon issues, with Roger 10 seconds of drawdown for like a total of 4 or 8 pips, whatever he said? Think about that. Those are the trades. You've got to become selective. I told you, be selective. Everyone sees this different. Everyone has different chart vision. I understand. Some of you are still struggling, and I want to help you people. Jerry, I know you're having trouble identifying the trading zone. I'm going to help you. And if anyone else is struggling seeing the trading zone, that's why I'm here. That's why you paid me. I will help you. But the ones that are getting it, congratulations. The ones that are taking a trade and reverting back to your old book stuff and sticking in a trade for more than 2 hours when you identified the second leg, did the GBP CHFW look good? Of course it did. I loved it. It looked perfect. But then what happened? They shifted away from the low and went into consolidation. That should have been a 10-pip scratch. Not bad for a scratch. When they hit the stops again, if you insisted on trading that pair, when they hit the stops again low, railroad tracks, you should have took it. That is the appropriate entry after you get stopped out. Didn't I give you this lesson yesterday? When they trigger the stops, wait 25 to 50 pips lower, below the low, and look to re-enter the trade. That's all you had to do. And you took, instead of taking a trade that was a loser, you should have been a net positive winner for the day. That's what my students are doing. Joe Dalton, he gets stopped out, but he takes the next cycle at the next drop zone. The drop zone is 25 to 50 pips below the previous low or above the previous high. Remember, the whole business is about the high and low? If the whole business is about the high and low, then you take the next high or the next low. 25 to 50 pips higher or lower. It's so simple. Think. Where does everybody put their stops in the textbook? 25 to 50 pips higher or lower. Okay, what do they trigger the stops in? 25 to 50 pip increments. Think about that. Look at the drop in here. Measure these. Measure these triggers. It's almost hilarious. Okay? You guys know they're going to do this. You are smarter than these guys. You know better now. All right, that's my soapbox for now. All right, let's get to the slides. All right, anyway, I'm excited. I hope you guys are excited as I am. This is absolutely amazing. I just, you know, it's almost spiritual what's going on in here. I know that sounds really weird, and some of you know me like, what the hell's wrong with that guy? I'm telling you, it's absolutely amazing. Of all the people that are having success, people winning contests, people doubling their account in one day, I just can't even tell you. I hope I'm on your Christmas list next year. All right, here's the deal. Some housekeeping also. Denise, Canton, Tom, Jenny, the Averys, Rosenblatt. My outbox is jammed. I don't know why it won't go. I got to think Verizon blocked me. I know my email address is the other site, but I use Outlook Express through Verizon to access that site. I pull the email server from there. So I got a log jam of outbox letters. I've answered everyone. But some people are writing saying, Steve, what's your problem, man? You know, you don't like me. What did I ever do to you? You're not answering my emails. It's not it. I answered everyone. Okay, Tom, I think you were the one that sent me the trade that you got stopped out on a W formation. I think it was you. It's sitting in my outbox, that drawing that I just went over for everybody. I got a lot of that, and that's why I made an example of you, and no offense, but that's, buy yourself a clock, buddy, and if not, tell me where you live, I'll ship you one for your stocking. All right, 2-hour time horizon, kill the trade. All right, pivot points. Again, let's go back over indicators. What do we know so far? Let's do a quick review. What do we know so far? Okay, market makers come out at 5 o'clock, they reset the high-low. They hit the high, they hit the low at about 15, 25 pip increments, create a 25 pip market maker spread. All right, you want me to slow down? I'm on Diet Coke, I'm jacked today. Okay, they make the market maker spread, the channel's about 50 pips. Sometime between 1 and 5 a.m., 1 and 4 a.m., they must exploit that channel. They come out of that channel, they widen the spread. They hit it high, hit it low, then they make the real move. Why do they hit it high? Why do they hit it low? Trigger all the breakout traders, all the pending order traders that trade the break to absorb those orders and beat them up. They then go, how many pips? 25 to 50 pips higher and form out the first leg. They then work that area for 30 to 90 minutes, but up to, say it, 2 hours. Okay? They will hang around that area. Why? Think. Why are they hanging around the high all day? What the hell's wrong with these guys? I want the market to move. Accumulating the contracts. They hang around the extreme points to accumulate the contracts, to create erratic behavior, hit the stops in both directions, and then it's off to the races. 3 levels of drop will be seen, but in that 3 level of drop, hit the stops high, hit the stops low, relieve the pressure, bam, next level drop. Hit the stops high, hit the stops low, relieve the pressure, bam, next level drop. Now we're at level 3, a little bit different behavior is seen. The behavior you've seen at the beginning of the day, the erratic behavior, will be seen again at the other side of the spectrum. Again, let's go back over indicators. What do we know so far? Let's do a quick review. What do we know so far? Okay, market makers come out at 5 o'clock, they reset the high-low. They hit the high, they hit the low in about 15, 25 pip increments, create a 25 pip market maker spread. All right, you want me to slow down? I'm on Diet Coke, I'm jacked today. Okay, they make the market maker spread, the channel's about 50 pips. Sometime between 1 and 5 a.m., 1 and 4 a.m., they must exploit that channel. They come out of that channel, they widen the spread. They hit it high, hit it low, then they make the real move. Why do they hit it high? Why do they hit it low? Trigger all the breakout traders, all the pending order traders that trade the break to absorb those orders and beat them up. They then go, how many pips? 25 to 50 pips higher and form out the first leg. They then work that area for 30 to 90 minutes, but up to, say it, 2 hours. Okay? They will hang around that area. Why? Think. Why are they hanging around the high all day? What the hell's wrong with these guys? I want the market to move. Accumulating the contracts. They hang around the extreme points to accumulate the contracts, to create erratic behavior, hit the stops in both directions, and then it's off to the races. 3 levels of drop will be seen, but in that 3 level of drop, hit the stops high, hit the stops low, relieve the pressure, bam, next level drop. Hit the stops high, hit the stops low, relieve the pressure, bam, next level drop. Now we're at level 3, a little bit different behavior is seen. The behavior you've seen at the beginning of the day, the erratic behavior, will be seen again at the other side of the spectrum. The erratic behavior will hit the stops in one direction mostly. Pins to the down, pins to the down, pins to the down. As if to be taunting us. Like a joke. Ha ha, go down there. Ha ha, go down there, I'll get you. And what do people do? They don't know, and they go down there and they get it. Okay? They quickly snatch the market away. They form out a W or just a single set of railroad tracks. They go back into consolidation, into the range to end the day. If you take that reversal trade, the sideways movement in that trade is the end of your trade. How many pips are going to be, Steve? I don't know. Most of the time, it's about 25 to 50 pips off of the high or low. But depending on where you got your fill, where you got your pull, it could be 30, it could be 18. Take what is given to you after a couple hours when you see the consolidation. If you grab the low of the day and they make the retracement, right, what is the fib numbers? 23.762 pi r squared. I don't know what the hell they are. I don't use them. When they make the bounce off of the fib and go into sideways consolidation, that's the exit. Don't sit there and wait for them to make the second pass at the level and give it all back. Take it. Because that is the end of the trading day, as we know it. Okay? Can it come out tomorrow and continue and make another 50, 60 pips? Yes. Are you going to be mad if you missed it? You shouldn't be. But most of you will, and you say, Steve's crazy, I should have held that trade. I understand that. But what's going on is that we don't know what happened overnight. We don't know what happened during the Asian straddle when they set up the market maker spread. We don't know which way the accumulation has set itself up. So now, that trade is broken down into a 50-50 proposition. I can't tell you enough times I am not a 50-50 trader. We are higher than that. Okay, there's people that are doubling their counts. I've seen their statements sent to me. They have not even dropped a trade since we started talking. They're 100%. Have you ever heard of anybody hitting every single trade? Me either. It's happening. It's absolutely amazing. Be selective. Pick the best trades. Okay? Now, let's get back to pivots. I'm losing it today, ain't I? All right. The pivot points are man-made indicator. I didn't invent them. Okay? But there's a couple of things that I learned from some other teachers that are useful in what we're trying to do. Okay? The pivots can actually give you a rough projection of where the high and where the low might form. Remember I told you to check the daily chart for the color of the candle and put it in your back pocket? Okay, well now I want you to pull it back out of your pocket. At 5 o'clock, depending on your dealer, maybe 6, maybe 7, when the daily candle paints, I want you to take note of that color. Pivots are an ADR projection.
pivots are an ADR projection. Why? They're based on the open, high, low close of that daily candle. So now, if the daily candle closes green, the projection is going to be that it will move, price will move between the M2 and M4 pivots. Okay? Let me slow down, I'm getting ahead of myself. Pivot points are calculated on the daily candles. They are an ADR projection for what may happen tomorrow. We know that we calculate ADR. I told you market makers have limitations on what they can do. So ADR is pretty useful for us. Yesterday's price action, yesterday's closed candle, 5 o'clock, gives you tomorrow's projection. So you have a rough idea of where the high, the M might paint, where the W might paint. Wow, not too shabby. A red candle indicates an M1, M3 day. A red closed daily candle produces the projection of M1, M3. A green candle produces a projection of M2, M4 movement. Understand this. M1, M2, projected lows, possible lows. M3, M4, possible highs. Okay? I didn't invent this stuff. It just happens to help out. The people that are struggling, this might be a piece to the puzzle that will help you start to see it better. Ironically, when the blue box paints, the pivots sometimes are, say it, 25 to 50 pips higher than the blue box. The M3 and M4, M3 might be 25, M4 might be 50. It's kind of funny and ironic, but it actually helps give you an idea of where that strike zone might occur. Okay? I'm going to draw for you in a minute. Here is a chart. It is not mine. I don't even know who sent it in, actually. But it's very, very useful. An M1, M3. The central pivot point on your chart is yellow. The central pivot point is an area where a lot of people take a trade, a break above and a break below. That is wrong. Don't do it. Think about this. I'm going to draw for you in a second. Let me oversimplify the example. I'm a market maker, and I go to my bosses, the families that control the universe and the world's wealth, and I say, you know, listen, I'm going to trade euro tomorrow night at London Open. What do you want me to do? Steve, I'm going to give you 100 pips. Okay? They're yours. They're your 100 pips. You work them how you need to work them, but I don't want you to go outside those 100 pips because I got a load of Toyotas coming tomorrow and I don't want to mess up the trade balance. Okay, cool. So now, I take my 100 pips and I think, I'm a market maker, what am I going to do? I'm going to take 25 of those pips and I'm going to hit the stops high, and then I'm going to take the other 75, run the trend. I'm going to trigger the W at the bottom, and I'm going to pull back into the range and close. Now, let's look at this on a candle. Let me draw for you. Okay, I'm sitting down. You guys probably can hear me. Okay, let me get out my little paint. I suck at this, so I'm doing the best I can. All right, here. A little pencil, a little thicker. Think about this. You are a market maker. There is a candle that needs a diet. Has a little belly sticking out. Okay, that's your daily candle, right? Think about this. What am I going to do to form up this daily candle? I'm going to hit the stops with 25 of those pips that I was allowed. I'm going to run the trend with the other 75 of those pips that was allowed. I'm going to pull off of the low and make the W and end the day here. Close. Right? Aren't pivots based on the open, high, low, close? So what we're doing is, how will the market maker distribute his pips tomorrow? Okay, now, since I know that the ADR of euro in this example is 100 pips, I have a rough idea that euro's trading zone will be 25 pips higher as a stop hunt, and then will drop 75 pips to the low, including this zone, past this Asian range, right? Now I got something. If you take the GBP USD, for example, that has a 200 pip ADR, what will the market makers do? They will take that same candle, right? Maybe this one doesn't need a diet so much. This one's skinny. This one's on Atkins bars. Okay, now, it comes in here at the open, right? What does it do? It takes 50 pips to work the high, forms the M, runs the trend all the way down in 3 levels, pardon my drawing, hits the low of the day, makes a W, pulls back for the close, and goes into consolidation. it takes the other 150 to complete the cycle or the pattern. Okay, so now if we're looking at GBP USD, this is my horrible rendition of a blue box with a sloppy mouse pen. The stops will be triggered 50 pips higher or 50 pips lower. Okay, that's why pivots are useful. They take the daily candle and they break it into pieces for us to understand how will the market maker distribute his pips. Think about a daily candle, right? Let me get you a new paper here. Okay, think about a daily candle, all the stuff that's going on in here now that we now know. Let me draw a big one. Okay, this is a typical daily candle, or any candle, right? Now think about this. What happens? At the open, market makers do this, right? Then they come right here. What do? They break high. Up here, they form the M within the bounds of this candle, right? Stop hunt. Then they go 1, 2, 3 to the low. 1, 2, 3. That forms out the real body of the candle. Then they make a nice fat W, and they come right here where the close is, right? And then they do this to end the day. All this that I've been teaching you goes on inside this whole thing right here. And it happens every single day. So if we know that the market maker will distribute his pips in such a way as to trigger the stops, fake traders out, run the trend, we have a rough idea of where that stuff is going to occur. That's why I told you earlier, I drew a picture for you in one of my slides back there. The trading zone is 25 to 50 pips higher or lower than the blue box. You get it now? Do you see? That's why pivot points are useful. Okay? Let me get rid of this, clear it off, and let me move on now. Okay. So, now look at this drawing. Okay? Here's the central pivot point. On a down projected day, he takes 25% of his available usage for the day and runs the stops high, and then drops down with 75% of what's left. Then he pulls off and closes here. In an upward projection day, here's the central pivot point. He comes out here at the open. He makes a big fat W stop hunt, or maybe some railroad tracks for you skeptics. And then he takes 75% of what's available to him and runs it up to the M4, where he makes the M, pulls back, goes into sideways consolidation to end the day. Now, we understand, right? This is how the pips are distributed. Understand that the gray area is exactly what it is. A gray area. We don't trade. Remember I told you who trades in the middle? Do I have to say it? Amateurs, suckers, chumps. Don't be one of those guys. Don't trade in the gray. You are looking for a trade off of here or off of here. The extremes of the high-low range. Period. That's it. Can you trade both ways? You can sell here and buy here. Absolutely. But do not chase the trade in the middle of the gray area. That is why it's shaded gray. Okay. Hopefully you understand and that was clear. Okay, so now, what do we have? Market maker comes out at the open. All right, I'm going to go through the whole thing again. Do I have to? Comes out at the open. The channel's 50 pips. He hits the stops high, makes the M with the 1/4 of his available allotted pips for the day. He then drops 75 pips down to the M1 low, makes the W, pulls back, closes right around the S1. Does that happen every day? No. Would it be so simple? Was that perfect? It would be more than easy. But guess what? It does happen quite often. So now, taking the pivots at the London Open around 2 to 3 a.m. Eastern Time, it's not going to be the same every time. In the winter, it's 2 to 3. In the summer, it's 3 to 4. Sometimes they hold it till 5. Sometimes they do it at 1. Understand, roughly, this is a rough time estimate. Adam, don't take it so literal. All right? Now, the London Open, they come out, right? We already know about the pivots. They come right here. They break high. You're a seller. They break high. You're a seller. They break low. You're a buyer. It's that simple. They break high and make the formation. You're going against the rest of the world. The bias against the rest of the world. When they break high, all the breakout traders get taken into the market. And sometimes they trigger the low side and pull those guys in too. When they break high, you sell. When they break low, you buy. 25 to 50 pips above or below the blue box. Simple. Those are the best trades. When you become much better at seeing these patterns, you could ditch the blue box. I know some people out in California ditch my blue box. And I said, why? I wasn't offended. I just want to know why. Because the blue box was messing up them seeing the tight consolidation before the stop triggers. So they dumped it. Was I offended? No. If you're making money and you dump the blue box, just remember me on your Christmas list. I don't care if you take my stuff and throw it out. I don't want you to add a million things on there because it gets confusing, and I'll show you that in a few minutes when I cover it. I have a picture of Kim's screenshot right before she met me. I'll show you that in a minute. Okay. When the London session starts, we know the projections for tomorrow are M1, M3. What does that mean? Price should move between the M1 and M3 pivot. On a down day, it will hit the M3 high first and drop to the M1 and go back into consolidation. On Sunday, Monday, or slow market days, sometimes it rattles around between those pivots 4 or 5 times, and damn if you can't grab all of it. Okay, M2, M4 on an up day. What does an up day mean? It means that yesterday's candle closed green, and we're projecting how a market maker will distribute his pips for tomorrow. Okay? This is what a typical pivot grid looks like. Here's the central pivot point in yellow. For those of you that don't know, most of you do. M3 is slightly above, right? Remember I said he comes out, hits the high, boom, drops all the way down to M1, makes a W, boom, closes somewhere in here or somewhere all the way back into the middle of the range. Just depends. All right, so what can we take from pivot points? M3 and M4 are possible highs of the day and are located above the central pivot point. M1 and M2 are possible lows of the day. They are located below the central pivot point. Okay? Above the point, below the point. The yellow line. Above and below. Now, what messes these up? Market maker trend versus real trend. That's what messes them up. Why won't the pivots work? There was a 275 pip move. When we take those projections and put them on tomorrow's chart, they're blown out. They're huge. Ignore them. Again, this stuff is a guide for us to identify the market maker pattern. Some people that are trading my method took everything off the chart and just looked for M's and W's coming out of that blue box. Is that enough? Yes, it works. So understand, M3, M4, possible highs of the day. M1, M2, possible place where the low will settle in and make the W, right? I want to know the projection of the range. Subtract M1 from M3 or M2 from M4. That's what's available to you as possible pips for today. Can they blow those ranges out? Absolutely. Why? Because the level count and the consolidation zones and the M and the W is everything. This stuff is man-made to help us get a rough idea of where it may do that. Okay, here we go. Consolidation, 3 to the high, boom, boom, right around the M3, shift the zone down, go make a W, back into the range, and then bam, if they don't nail M1 right around the US Open, they come right back into consolidation to end the day. Consolidation is seen right at the M2. The projection was M2, M4. Okay? Price ran the stops right at the London Open, quickly right below the M2, came back above. 1, 2, 3, into chop, level 3 is seen, spike above the M4. There's your target, target achieved. M3, M1, M3, M1. One of those days I talked about. Price comes out at M3, nails it, well, missed it. Comes down, just misses M1, comes right back up in 3 moves, throws 2 pins right to the M3. I promise you it hit. There is sell, buy, more pips than any person deserves in one day. Go to bed. All right, they shifted the zone off of the high into consolidation right at the M3. There is your M pattern, M formation. Price dropped right out, spinning top, quasi, whatever you want to call it, right back into consolidation right around the M3. This happens over and over and over. Here's the pattern. Consolidation, trigger the stops at or near M2, come back near it one more time for a nice 1, 2, 3 to the high, hit it high again. They consolidated M4, they hit it one more time, and came right back below. This is one of those examples where M2, M4 was off. But we were expecting one more rise out of here because why? Because we're smarter than these guys now. We know that there are 3 levels of rise intraday or 3 levels of rise carried out over 2 days. So we expected one more move high, smarter than a pivot point. Okay, we're not going to do this drill. The pivots are projected for you on the chart. Understand this. Pivot points are an ADR grid. The extremes are representative of the ADR high and low. I'm projecting M3 to M1 where the ADR high and ADR low will paint. Since the grid is fixed and trading ranges are not, market makers vary the spread and the range based on contract buildups, right? So, since the grid is fixed and trading ranges are not, let's couple pivot points with an ADR marker for stronger confirmations. Okay? The ADR marker is a floating indicator that tells us the average of the last 2 weeks, not calendar weeks, trading days. Now, if ADR high lines up with M3, and there happens to be a jar of mayonnaise sitting there, I'll bet you $100,000 it's going to go right there like a magnet. That is going to be your sell zone. If M1 is sitting there with a watermark and an ADR marker and yesterday's low, light blue tracer, that is your strike zone. Understand, now you have an area where multiple confirmations, a confluence of events, if you will, have come together. So, pivots are intraday support and resistance, as much as I hate that word, because support and resistance is man-made by the market maker and can be exploited at any time. But understand that a break of one of the levels gives way to the next pivot level. Okay? Some of you getting scared and getting out of your trade at 25, 30 pips, it's okay. Some of you are picking the bottoms and the tops with no problem, and then you're seeing a nice little pullback. They always make the pullback at a level one, right? They make the peak formation low or high. They hit it high. They show false support and resistance at the pivots too. Then they hit the stops high, hit the stops low, and continue on about their way. So don't fall for this stuff. It's part of the business. This next bullet point is it. You, my friend, are the filter. Identify the market condition and the candle pattern for the next level support and resistance. And the count needs to be written in here. I'll write it in. If you get peak formation low right at the London Open, you get the second leg of the W, and you get out because the central pivot point's laying there, shame on you. The count, 1, 2, 3, 135 pips is sitting right there for you. We know the ADR, about that. That's about what it runs in that pair. We're looking for the count now. If the W is the entrance, the M is the exit. If the M is the entry, the W is the exit. Or, end of day back into consolidation. That is also an exit. Okay? The biggest problem that most of my students are having is micromanagement of their trades. Why? Because you just can't believe it's that simple, and you can't believe that this idiot from Florida is teaching you guys how to trade, and you just don't want to believe it because of all the stuff in the books that you've read that there's no way it can be this simple. So what's happening is you put something on, it's up 25, 30 pips, you go, holy crap, I better take this before it retraces. Any trade that you take through me or through my method is valid until that low or high is broken, period. Okay? So if you take a trade off of the low, they make the second leg formation, they come down, and you grab that right there on the second leg, that trade is good until that second leg is challenged again. Look at the example for USD-CHF from yesterday. Came right out of the box, first leg, bam, pull back, second leg painted. That's the signal, right? You took that trade long. Did they ever come back near the leg again? No. They went up, hit the stops high, hit the stops low, next level's underway. They hit the stops high, hit the stops low in one bar, next level's underway. You are now at level 3. They make the M, you're a seller. Exit your long, take a sell. Stop loss goes above the high of the day, right above the first leg of the M pattern, right? You now take the trade short. For some reason, the contract buildup didn't work out. Tom, your clock's running, 2 hours has elapsed, you're a +5, -5, I don't care which. You take a scratch. You made 135 long, -5 short, not a bad day. Okay? I know I gave you a million things to remember, and I know you can't remember them all. But this is the difference between memorization and conceptualization. Go home, watch these videos. These videos are a gift, okay? I don't allow this stuff. I don't allow a textbook. I don't allow even people passing notes. I don't like this stuff. I'm worried about this stuff getting published. This is my life's work. Think about it from my perspective. I allowed this because Kim insisted on it. Okay, now, people had to travel all over the country to see me a second and a third time. You have the luxury in your underwear for some recordings. If you are lost or struggling, take my class 5 more times before they take it down. Okay? Take my class 5 more times without costing yourself a penny. People that have traveled have spent $1,000 for the week on a hotel, $600-700 to fly. They rent a car. They got to eat. That's the luxury that she gave you guys. Okay, now, if you're lost and confused, that's what the recordings are for. Go in there. First of all, take a couple days off, let this stuff soak in. Because a lot of you are like, what the hell is this guy talking about? I'm losing it. And a lot of you are not. The ones that are like that, you need to take a few days off and just let it sink in. And go back and play around with the charts. Just let it sink in. Then come back, maybe after Christmas, between the Christmas and New Year's break, and watch the whole thing again. Okay? You don't understand that this is a huge gift to look at these videos. I'm not happy that they're up there because I'm getting emails from people that some of the integrity has been compromised, but it's over now. It's nothing I can do about it. It's always the one guy out of the 303 that are in here. It's the one guy that does that. There's nothing I can do about it. So now, they're up there. Use those videos to get this stuff. Okay? You're going to be successful in this business. Big market moves often disrupt the pivot points for the following trade session. In order to find opportunity, just got to set some rules for trading when price comes out of the wrong segment of the trading zone. You know what the rule is? Ignore the pivots, identify the pattern. Man, there it is. Last time you guys are going to see this on the tape. All right. What time is it? It must be break time. Yeah, it is. Let me find a place to stop. It's pretty funny. You think I would have shut this thing off. All right. Here's the rule. You ready? Ignore the pivots, identify the pattern. That's it. Nothing else. Okay? Showing you that price comes out in the wrong segment. Here's the central pivot point. There's the mayonnaise. It didn't go up to the M3, but damn if that isn't 3 swipes at the high M formation with 3 pins. Mayonnaise holds. Sell. Okay? That's what I'm talking about. When the pivots get disrupted, make the adjustments. You're smarter. You are smarter than a grid or a pivot grid. Okay? Straight away, comes out of the box. The trend is down. Market maker peak formation high was here. Makes a limited stop hunt inside the box, but pins the 50. There's your M. That's a sell. Okay? Notice we are below the central pivot point, but we are selling. Okay. This is actually a pretty good space to take a break. Okay? Some of you say you can't hear me, and most of you, the majority, have heard me for the whole time. Please let me know. Okay, cool. All right, 7 o'clock. Let's do a 10-minute break. I'm not going to do the 15. I'm going to do 3 10s tonight. All right? So if you need to eat. But we're going to get through this material. And now that I'm thinking about it, this is what I think I'm going to do. I'm going to get through as much of the material as I can. I'm going to save the scripts and the scaling in for January the 4th. Okay, it's too much confusion. A lot of you know how to use them already, a lot of you don't, so I don't want to waste your time teaching you how to drag a script on a chart. Okay? So here's what we're going to do. We're going to take, Kim mentioned something about doing possibly a survey to see where the questions are. I will poll the questions, I will go through them, and try to get a generalization of the most commonly asked questions, 8, 10, 20 of them. And I will reteach you those questions that you are stuck with. So when I come back on the 4th, we're going to reteach the material. I'll go through the pattern again. I'll reteach and answer the questions. And then for the ones that want to hang around, we can do the scripts and execution. This way you don't have too much information to worry about learning the platform and learning the method. That's how I think we're going to do it. And I'll run that by Kim. I guess this is the first time she's hearing it too. I think that's what we'll do. But understand that I am here for you to get this. Most of you are. I'm very happy. But I don't want to leave the ones behind that are not. So we will figure this out together. And if you're still lost after watching the recordings 100 times, come to Orlando. That's what it's for. Okay? It's 7:03. Let's go 10. See you around 13, 14. Thanks.
Nevertheless, we use them. Would you say that pretty much all the indicators and oscillators measure the same thing? Right? They all plot above or below a 0 or a baseline. Some it's the 50, some it's a 0. If you use multiple indicators or several, which one wins? You say, oh, the CCI looks good, but MACD looks this way. Let me not use the CCI. I'll go with the MACD. Which one is going to win? Why not master the use of just one indicator? That's it. The pattern trumps everything. But if you master the indicator to help confirm the pattern, the system or the method may become much easier for you. Okay, this was Kim's chart from, I don't know, about a week before she met me. And I'm kidding, obviously. But this is a lot of your charts. A lot of you people have this. We're trading like this. First of all, you can't even see the price action on the candles. Second of all, if those things fire, which one is the right one? Which one is the wrong one? You should absolutely not be doing this. What happens is, and I know this happened to a lot of people, especially in California, is they've been trading, can't have success. So someone comes along and says, I'm using the MACD histogram. All right, let me add that to my set. Maybe that'll help. You know, I started using this ADR marker, and if you put the MACD histogram with the ADR marker, you'll have a better chance of picking good trades. Okay, I'll add that on there. Hey, you know what? This AO that Bill Williams invented with the ADR marker, the CCI channel, and the MACD histogram is really good. This is the next greatest thing since sliced bread. There's people using a thing called rainbow stochastic. There's people using, I don't even want to make fun of anyone's indicators, all right? I'm not. But here's the deal. You keep adding things and thinking they're the holy grail. And what ends up is your chart looks like this. And there is no way you can trade from this. This is absolute garbage and clutter. So if your chart looks like this, I'm calling you out in front of everybody. Get that crap off of there. Get down to the set I gave you. The indicators simply indicate or help you identify the pattern that I've taught you for the last 3 days. Okay? You are smarter than an indicator. Simple. You're smarter than a blue box. You're smarter than some pivot lines on a chart. You're smarter than any indicator that you happen to have posted at the bottom of your chart. Okay? The pattern trumps everything. I can't say that enough. The pattern trumps everything. Some guys ditched all that stuff, trade the blue box. So moving average lines on there. That's fine. Why moving average lines? Because the 50 and the 200 give you the targets for the retracement back into the range, or find support and resistance on the M or W formation, because the mayonnaise is like a magnet. Okay, so that's why they left those lines on there. Can they get rid of those lines completely too? Yes. But if this is your chart, get rid of this stuff. Use the set I gave you. Can you add some sand spurs and some things and California guy? Yeah, you can do that. I'm not going to be offended. But don't add so much that you can't even see the pattern anymore. It's ridiculous. Okay? I like RSI. Can you like MACD? Yeah, I don't care. I like RSI. And understand that the RSI is the underlying indicator that is inside TDI. But in order to use TDI properly, you got to understand the RSI, right? So I'm going to try to help you understand the RSI. If you're confused after this, go buy a book on RSI. It's inexpensive, it's $20, probably online you can get it. And understand that if learning how to use the underlying indicator that Dean's TDI is founded on will give you a better foundation on how to use the indicator itself. Okay? RSI is based on the close. It doesn't fall for the market maker spikes. Think about that. That's why I like it. It's based on the close. Market makers throw spikes to trick you. RSI ain't having it. It knows better. It helps you confirm shifts in momentum. When market maker gives you the centerline crossover, the 50, it's showing you the change in momentum. Now, does that mean anything during the stop hunt? No. But it means something when you're identifying the trend move after the stop hunt is over. So what happens is price comes out, cuts the low, extends it in 25 to 50 pip increment. It makes a W. It rolls over, starts heading up. TDI confirms and crosses the market baseline, the moving 50.
That is a confirmation that you are now in the right directional move along with the market makers. Okay? It is also, RSI is also excellent for spotting divergence, or divergence, however you want to say it. What's the big deal about divergence? Divergence will pick up, or divergence will present when market makers hit the stops one more time. Okay? Very important. What is divergence on the chart? Think about this. Divergence is an aggressive move higher or lower that closes right back above. If I just told you RSI is based on the close, when they throw a 25-point spike and come all the way back up and close, price is lower. RSI is not, because RSI is based on the close. It didn't fall for the spike that the market makers throw to trick us, so it will be divergent. So now we're looking at it differently. RSI is going to help us identify the stop hunt. It won't fall for the spikes that are detrimental to our account. Now we start another piece of the puzzle. Now what do we have? We have a possibility of divergence. I think if you look at the trade where you guys thought that Euro was making the high and it hit it again and came right back, TDI was divergent. Okay? That is a clue that that possible last spike towards the high is the last stop hunt for the day or for that period of time. That helps you pick the high of the day. Why? Stop hunts are big, quick, aggressive moves towards the high or low, and they close lower most of the time. RSI nails that. That's what it's designed for. It's perfect for that because it's based on the closing value, calculated X amount of periods back. Okay, the simple basic stuff about RSI. Most of you know this. Most of you will be bored. If you want to go eat a sandwich, go eat one. But we all know that it plots above or below a market baseline. In this example, it's 50. In MACD, it's a 0. In CCI, it's a 0 line. But this is the middle line. When the baseline or the market baseline is crossed, that is noted as a shift in momentum. That means that the bias or the momentum in the market has changed from down to up or up to down. Okay? Overbought and oversold are the extremes. The extreme high or extreme low of the grid. What will happen at those points? M or W will be present. Now here's another one for you. The M or W will be present in the RSI itself. So now another piece to the puzzle has just been dropped on you. What do you have? Price comes out of the box, cuts the low, 3 swipes down, price is divergent, the second leg forms out. A W actually forms with the RSI line itself, even if you can't see it in the price. Maybe you're a little cloudy, maybe you still think I'm crazy. The RSI will paint a W. You can draw trend lines within the RSI. Someone asked me, do I use trend lines? When you're learning, draw a trend line on the RSI. Why is that more value than a trend line itself? Because it's based on the closing value. So when there's a spike above or below the trend line, you won't fall for it. Okay? That's why you use a trend line on RSI. Okay, typical range analysis with the RSI itself. We know that the value plots between 0 and 100. The normal trading range is about 70 to 30. The bull range, or an uptrend range, is 80 to 40. Well, what does that mean, Steve? It's kind of weird. I don't know, bull range, what is that? You don't talk about that stuff. That's stock market stuff. What does that mean? It means that the RSI/TDI will find support slightly below the market baseline and make a W and then head back towards the 80. Bear range, exactly the opposite. The RSI will find resistance slightly above the midline, the 50, and make an M and head back down towards the 20. Now, if price is in a downtrend for 2 days, we know we're coming to level 3. What will happen? The RSI will retreat slightly above the baseline to around the 60, make an M formation in line with the market itself at the right time of day. Between when? 1 and 5 a.m., 1 and 4 a.m., 2 to 4, somewhere in that time, right? London Open, end of Asia, London Open. All those things coming together is starting to show more confluence. What pivot point might it be at? M3, M4? Okay, remember the possible highs of the day. M3 or M4. Don't you see all the things coming together? RSI, TDI paints an M. There's divergence. Market makers make a spike to the high 25 to 50 pips higher than the blue box itself. They go into consolidation 30 to 90 minutes, accumulate contracts. The contracts are building. They're validating the long patterns, all the fib traders. You know what's going on. The spread opens ever so slightly to absorb those orders. The market seems very erratic, but is not actually going anywhere. These are the things you are looking for. Are you going to remember them all? No, that's what the recording is for. Make a list of this stuff. Memorize it. And when you're looking at the chart, say, what am I looking at? Don't just stare at a blank screen with a blank stare sitting there going, it's up there. What the hell's it doing? These are the things you're asking yourself. What is going on? Market makers cut the high in 25 to 50 pip. I see that. They threw a needle to the high. TDI picked it up. It's divergent. One leg out of the band, one leg in the band. I'll show you that in a minute. I see 2 pins to the high, M formation. Damn if TDI doesn't have an M in it. TDI crosses back over the waterline. The shark goes underwater. We got a shark fin high sell at the mayonnaise. Right? That's the stuff I'm talking about. All those things coming together, creating a confluence of multiple things that I've been talking about to help you identify that you are in the right part of the trade cycle. Okay? This is a typical RSI grid. This is out of a textbook. Literally, this is out of a textbook. The 50, the middle. When RSI is trading above the 50, the trend is said to be positive. When it hits the first zone between 70 and 80, it is initially overbought. When it hits the 80 to 90, it is extreme. The thing that these indicators cannot account for is that the line can break these zones and stay there for a day or two. If price is moving like crazy. On the lower time frames, it could break high and stay there. That is where the count comes in. If your RSI breaks high and stays up there sideways, high, between 80 and 90, the indicator is of no use to you. So what takes over? The level count. And when an indicator is extremely overbought or oversold, it is of no use to you. How do you know when it's going to reverse? You're going to give a lot of pips back by waiting for it to retrace back into the range on the indicator subgraph, right? The count takes over. Okay, so if you're using RSI or TDI to confirm your trades, and it hits the extreme and stays above for a while or below for a while, the count takes over. What level am I at, Steve? There's erratic behavior, level 3. It's carrying into the next day. I get it now. I'm waiting for them to hit the stops high. When they hit the stops high, I'm going to exit. Why? Hitting the stops high is 25 to 50 pips higher. That gives me another 25 to 50 pips in my trade. Get it now? You're selling stop hunt to stop hunt. So if you catch the consolidation zone at the London Asian session, they cut the stops low, TDI or RSI is down, who cares? We don't care about that. But it happens to be oversold extreme. They hit it again and it shows divergence. One leg in the band, one leg out of the band. W forms. The shark fin to the low paints. It crosses back under the water. It takes a bite out of somebody and turns red. Now, we got blood in the water, shark fin low. We take it long. Now, what happens? It makes a 250 pip run to the high. RSI happens to be pegged high on the top of the subgraph and it's just painting sideways. What the hell does that tell us? Nothing. Now we're at, what level am I at? 1, 2, 3. I'm at level 3. I'm high. I see it. U.S. session's coming. There's the red box. I'm looking for 2 pins to the top side to get out of this trade. Okay? When 2 pins fire, first leg fires, second leg fires, I see it, pins to the top side, that's the exit. Forget about the indicator. The exit is the count. There is no substitute for your head and your knowledge about what I'm telling you to make those decisions. No substitute whatsoever. Okay? So here are the range rules. We talked about them. The RSI will oscillate between the 80 and the 40 during an uptrend, the 3 days following the market maker up move. The bear range is exactly the opposite. If you see it above the 50, but you know it's been going on for 3 days or 3 aggressive levels, you are the filter. The RSI is of no use to you. It is not in an uptrend. You are waiting for the reversal because you saw 3 levels of rise for 3 days and there happens to be 3 levels of rise on the last day. You know the reversal is imminent. The RSI is of no use to you.
The TDI will be of use to you to help you identify the shark fin high. Okay? All right. In an uptrend, we all know that it takes a couple of hours and days to work those charts and turn them over, right? So what happens when you're looking at these indicators? At point 1, the short-term trends start turning over. Right? At point 2, I'm talking about like the 5, 1 minute, 5 minute, 15 minute charts start to turn over. The intermediate trend, 1 hour, 4 hours, start to turn over at point 2 when it crosses the baseline. Okay? It is also true of the lower time frames, but by the time the 15 minute reaches the market baseline crossover, you're late to the party, folks. I don't want you trading from there. That is a sucker's trade. I want you trading at the extreme of the zones. Remember, my trading zone is a few pips off the high, a few pips off the low, not the middle of the RSI crossover or the TDI crossover. That is late to the party. The trade is the outer ends of the range. Okay? So now, when point 3 happens, the intermediate longer-term trends start turning over. Perhaps the dailies catch up or whatever. But you have to understand you are the filter. Where are you in the cycle? The cycle and the market maker pattern outweigh everything that is man-made that has been placed in textbooks that's on the chart. Why? Because market makers go against all this stuff to beat the people that trade it. So now you understand that. That's why it is a guide and a guide only. Okay, the inverse is true for the downtrend. Exactly like I just said. The charts are rolling over. Okay, divergence. Some of you don't know what it is, some of you do. Divergence is when the price goes up, but RSI doesn't fall for it, and it turns over. Bull divergence is exactly the opposite, right? What happens? The indicator has already started making the up move, but price makes a down move. Now, look at this for a second. The RSI value is painting the perfect W, where point X is lower than the next swing. Leg 1 of the W is lower than leg 2, even though price is not. Remember when I talked to you about the leg ideally needs to be exactly how the A and C RSI values are showing? Well, guess what? If market makers throw the spike below the previous high or low, or above the high, below the low, then what happens? It looks like to you that M or W has failed. But when they close, RSI catches the closing value and goes, ha-ha, I got it. It's divergent. I ain't falling for that. So now, the M or W will be present in the RSI value. Add the bands that Dean has plotted on that indicator, and you will have point X outside the band and point 2 inside the band to further confirm that you got something. Okay? This is what it looks like in just simple RSI value. The RSI is flat. Market makers throw the stop trigger one more time, the spike high to get people, right before the chart just so happens to turn over. That is topside divergence. I didn't invent it. It's been around forever. But it is a precursor to a signal. Understanding where you are in the count, the stop hunt, what market cycle or condition you are in, will validate those patterns for you. There it is carrying into the next day. They made the 3-level drop. They hit the stops low, and at the beginning of the Asian session, which, Gloria, you're not allowed to trade, RSI was showing divergence. That gives you an idea that's possibly the bottom. The other clue is they hit the low and came near it but didn't break it. Okay? Very simple trade. Look at what happened here. Market makers come out. Here is the consolidation zone that all the breakout traders would draw. Can't draw on this. They would have a line here and a line here. Look what those guys did. They hit them high, stopped them out. Hit them low, stopped them out. They absorbed the breakout pendings on either side and choked those guys out in both directions. If they went long again after they got choked out, they got choked out again. And then when it finally passed through the zone again, if you didn't take the 4th breakout trade, you lost for today. And most people do not have the stomach to get stopped out 3 times in a row and then pull on the 4th.
So now, a better way to trade. 25 to 50 pips higher than the blue box, at a pivot point, divergence is seen on the RSI. Notice how the resistance is slightly above the market baseline in this example. What did I tell you it's going to find resistance at? This is 50, that's about 60. Right? So it found resistance at the 60 and turned over and made the run. Exactly what I've been talking about. Here is a W formation. This is market makers making an extra leg work going into a midweek reversal. Look what they did. They hit the lows formed mid-London. They pulled back, and right before the session end, a W was formed. They hit it and closed above. They hit it, closed above, hit it, closed above. They shifted the zone away from those traders, and then they couldn't help themselves. There was some more money laying down in here and in this aggregate, so they went and they got it. But RSI ain't having it. RSI is already pulling away. The train has left the station, so to speak, but when they made that third pass, you can pick this off because this is coordinated with the equities open at 9:30 and there's divergence present. That's what I'm talking about. That gives you the confirmation, shoulder, head, shoulder, the confirmation to pull the trigger or to stop right here and understand you are solid gold. Then when the session changes over, they shift the zone off of the lows and they run the trend, level 1 into 2, back to the mayonnaise. Okay? This divergence tells you they're working and trapping the traders. Working and trapping the traders, working and trapping the traders. But what happened here is the average of all the closes in this aggregate happens to be higher than this previous low right here. That tells you the brakes have been applied and they are bouncing, getting ready to make the reversal. Hit the stops, 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 induce, take the traders, absorb them in, grab the pendings, and then shift the market away from them, divergent the whole time. Through mid-London all the way to the U.S. Open. Not the golf tournament, by the way. Topside divergence again into the next day. Here it is going into 2 sessions. A lot of you might have taken this W, but what happens? The contracts were balanced in such a way that they had to come back and hit it one more time for the reversal held. Here's the example where TDI was outside of the band. There's a little baby W right there. Then it came back on the next move inside the band. That is major divergence. Price is lower. TDI ain't having it. It says, I ain't falling for that crap. I've seen it before. I know it's a stop hunt. No problem. I got this. Okay, does everybody see that? Let's not do this homework. Let's keep going. So understanding basic trend analysis with an indicator, RSI or TDI. Here's a summation of what I just said. RSI will range between 80 and 40 in an uptrend. You expect to see spike bottoms or W's. You expect to be moving. You expect to see the moving averages positive, 513 above the 50, and also above the 200. Right? Typical stuff. Now let's apply that to the market maker trend. In an uptrend, I do expect to see RSI or TDI raising higher. But what happens is when I get the peak formation low, this is an uptrend, I see the midweek reversal or the W formation or perhaps railroad tracks at the extreme low of the chart. I expect this uptrend to hold for 3 days. I expect intraday to produce 3 levels before a retracement is seen for market makers to get some of their cash back. In a downtrend, it's exactly the opposite. RSI will be oscillating between 60 and 20. It will find resistance or pain in M. You will see spike tops, wicks to the high, 2 pins to the top, 2 pins to the mayonnaise high. You will see an M top, M patterns will be present. So let's go through the 3-day cycle. Price comes out on Sunday, Monday, makes the false move, traps people high, it runs up. You have the highest point on the chart at London Open, that is peak formation high. It pulls back aggressively into the middle of the range during the London session. At the U.S. session, it repeats that level but fails to break it. You have a big, fat M Sunday, Monday on the chart. Now, we expect the next 3 days to drop. So we have Monday going into Tuesday. They drop, go into consolidation. Shift the zone off of the higher level long holders, right? Then what happens? It's in sideways consolidation. The averages on the higher time frames are negative, 513 and 50. 513 is below the 50 and below the 200. The averages are starting to open up, right? Now, here's what happens. They go into consolidation into the next day. After the peak formation high goes into level 1 consolidation, what trade is warranted at this segment of the chart? One trade only, straight away. They come out. What happens here is we don't expect them to hit the stops 25 to 50 pips higher than the blue box. We expect them to just roll it over and drop. Okay? The next night, they go back into consolidation. Now, we're at level 2 consolidation. What do we expect? All the stuff still applies. We're still in a market maker downtrend. We expect them to come out of the blue box 25 to 50 pips higher, hit the stops high, we're sellers. Drop. Into level 3. We are now into level 3. It goes into consolidation. Steve, I'm not sure if I'm in level 3. I'm still a little confused. How can I tell? Head and shoulders is present. Market is choppy in both directions. It's kind of erratic. And you look to the left and it's been dropping for the last couple of days. That's how I know where I am in the cycle. Does it mean that it will continue reverse or continue? We don't know yet. We have to wait for the signal. What's the signal? The signal is they hit the stops low at the London Open. That's the reversal. The pins switch from being on both sides of the consolidation zones to being only on one side, the downside. And then now we understand that we are in a retracement or uptrend in order for us to book a profit back the other way. The 3-day cycle has completed. Now we expect a unidirectional swing for the rest of the week, or after the retracement is made to mid-session, a new peak formation high will form, and the trend will continue down. That's it. That's all they got. People have written to me and said, Steve, I don't understand. The trend's been down for 27 years on Euro, and you're telling me that it goes up and down in 3 days. If it goes up and down in 3 days, it won't move anywhere, right? If it goes up 3 days, down 3 days, it won't move. They have to change the levels, of course. So the 3-day cycle is simply this. They give out their money on Monday, give out their money on Tuesday, give out their money on Wednesday. By U.S. session Wednesday, we need some money back. We're getting low. They reverse the market and take it all back. They are heavy at level 3. That's when they make their money. Okay? Market makers' limitations are this. You know they have to reverse because of this and this only. When you're buying, they're selling to you. When you're selling, they're buying from you. They cannot do that forever. They will run out of equity. So, when they're giving out their money, whether it's long or short, at some point in time, they got to get it back. So now, 3 days, they start to run low on cash. Nobody likes to run low on cash, right? They'll get it all back in the level 3 behavior by chopping the market, hitting the stops in both directions, creating erratic behavior, confusing the traders, and then reversing off of that low and taking it all back. Simple. Okay, TDI. I threw a little note on there. Thank you, Dean and Compass, for allowing me to use these slides. I really appreciate it. Okay, Trader's Dynamic Index. I didn't invent it. We all know who invented these right here with us today. Okay, is it a better RSI? I think it is. It's going to give you better signals and trade confirmations. It's also a very powerful tool to scale in with when used in the proper context of the market. If it breaks outside of the band during the stop hunt, you take that, shame on you. That's not the signal. If you learn how to use it properly, it's going to help you build confidence in your trade calls. And it also identifies the divergence very easily. I've been talking about that. Okay. It's a hybrid indicator developed to indicate market conditions related to trend, direction, momentum, and market volatility. It's an all-in-one indicator. Some of you like Bollinger Bands. Some of you like different things. There's bands on there. There's crossovers. There's everything. It's all that you need. You don't need 75 indicators on the bottom of your chart like I showed you in Kim's picture. You simply need one indicator and one indicator only. And as far as I'm concerned, this is it. Okay, to break the indicator down for you to understand what you're looking at, we simply have a green RSI price line. RSI is RSI. Me or Dean didn't invent it. It's been around forever. Okay, understand that we use RSI set to 21. That's it, 21 look back. Why? It just so happens to line up nicely with the averages and the market maker moves. Could it be 20 or 22? Sure. Okay, we use a trade signal line. The trade signal line is actually going to give you the confirmation much earlier than waiting for it to cross the 50, which is traditional in any indicator, not just RSI. MACD got to cross the zero line. CCI need a zero line cross or zero line reject. So understand that when you get the green crossing the red, that is confirmation. We call that blood in the water. We call the green crossing the red, the shark took a bite out of somebody, there's blood in the water. And I'll show you what I mean when I get there. Hold on. Market baseline. This is very, very interesting. We know on the indicator that 50 is the market baseline, and it's fixed. So the best way to describe this line is that it is a liquid 50. It moves. It's fluid. It actually comes down to meet you a few bars earlier. The signal is here on a standard or traditional RSI. But because the gold line or the market baseline is moving and it's fluid or dynamic, it comes down and meets you a couple of bars early. That gives you an edge on your confirmation. Okay? This is how the market baseline catches market reversals with price action. Okay, now what happens? The fixed 50 line, the fixed 0 line in MACD, what we have is an edge. We have a market baseline that moves. What does it do? It comes down to greet the RSI line 4 bars earlier, 3 bars earlier. What does that do for you? It helps you identify the top and bottom like nobody, sooner than a market baseline cross. That's what's beautiful about the gold line. That's why I love this indicator. Okay, volatility bands. I don't know the formulation. I think it's 2 standard deviations above and below the market baseline. I don't know for sure. Dean's the only one that knows. Okay, here. Now, think about this. This is kind of ironic that this is in this slide, because here is the consolidation, stop hunt, crossover signal, divergence, in and out of the band, reversal. Does everyone see that? Isn't that kind of crazy? Consolidation, stop hunt, trend run, right? Level 1, pullback, level 2, level 3, divergence, and level 3, reversal, exit the trade. It's kind of crazy, right? Consolidation, stop hunt, level 1, 2, 3 to the high, get out, sell. You can actually see the 3 levels inside of the TDI, RSI. You can actually see the signal. And if you notice, this is a little shark fin right here. But we actually have a shark fin that we like above or below the support or resistance fib number supports, which is almost solid gold back up the freaking Brinks truck to your house. Okay? The volatility bands act as support and resistance. They're based on the close. It's much stronger. So when the band contains the RSI line after a break, you will see divergence. It usually identifies the stop hunt without fail. When this is viewed in the proper context of the market, they identify the stop hunt, scale ins, and the exits in the trade. Okay? Here you go. It's hard to see these slides, but here's what happened. Here is the consolidation, right? They hit the level in 3 moves. 1, 2, 3. TDI catches a break of the band, and the next one is inside the band. The price action on the second swipe is divergent and is contained by the volatility band. What does that mean? Market makers flash the stop with as little money as possible. Why? Why would they waste another penny than they had to get what their target is? So the volatility picks up when they flash the market. On the second pass, they try to use less money and pull it back quickly and make the close. The first flash breaks outside the band, creates the shark fin, or the divergent, the first leg of the divergence. The second move towards the high or low is usually lower inside the band. The closes are lower. So now, TDI will show you out in on the band. That gives you the signal that is about to set up. Here is the second pass to the high with an inverted hammer. Sell, for God's sake. Hope you guys see that. Okay, here are the rules for how I like to use TDI. Okay? And again, I want to thank Dean for letting me use the slides, and I want you guys to understand that I am in no way disparaging Dean's TDI. Understand that I love this indicator, and that there's many good things in there, and if you put these things I'm telling you in line with our market maker pattern, you will be successful using this indicator. Okay, shark fin short. Okay? I try to have fun with the business, man. Shark fin, what happens? We're all afraid of sharks, right? We know these guys in the business are sharks. The bands are tight. They show the consolidation zone during the... I like to use TDI. Okay? And again, I want to thank Dean for letting me use the slides, and I want you guys to understand that I am in no way disparaging Dean's TDI. Understand that I love this indicator, and that there's many good things in there, and if you put these things I'm telling you in line with our market maker pattern, you will be successful using this indicator. Okay, shark fin short. Okay? I try to have fun with the business, man. Shark fin, what happens? We're all afraid of sharks, right? We know these guys in the business are sharks. The bands are tight. They show the consolidation zone during the Asian range. The RSI line breaks out and comes right back in. In the right context of the market, that is identifying that you're at the stop hunt level of the market or phase of the market. It actually paints what looks like a dorsal fin. It looks like it's coming out of the water. We made our bands blue. So it pretty much looks like a shark fin coming out of the water. The fin goes back under the water line and crosses the red signal line. There's blood in the water, folks. Hopefully it's not your blood. Hopefully it's the other trader's blood. So now you have a shark fin short, crosses the red signal line, there's blood. The shark took a bite out of somebody and came right back in. There it is. Does everybody see this? Okay. Start over here. 5 o'clock, high and low reset. Asian range, 31.2 pips. Market makers hit the high, hit the low, trade in between the range. Sometime between 1 and 4 a.m., they break high. They trigger the stops and the breakout orders. TDI breaks out of the band, goes shark fin right to the resistance line. It goes into consolidation near the high, throws 2 pins. TDI comes back under the water, takes a bite out of someone's leg, and it turns blood in the water. You are a seller. The trend rolls over. TDI goes 1, 2, 3 waves down, comes back inside the band, the trade's over. Notice that it also made the move around the R1 pivot. Right out to the R1 pivot, 2 pins to the resistance 1, 25 to 50 pips higher than the blue box. Shark fin high, sell. Shark fin high, sell at the resistance. Consolidate for 1 hour, 1, 2, 3, 4. You should be in here on the second pin close. If you missed it, this is still a valid trade when the shark takes a bite out of the red. Okay, shark fin long. The channel is 37 pips. Steve, why didn't you take this little baby shark fin here? It's not 25 to 50 pips below the box. Right? They cut the low, 1, 2, 3 to the low, big fat railroad track, shark fin long. The shark goes back in the water. He happens to take a bite out of someone's leg at the same time he goes back under the water. Maybe that guy was snorkeling close to the top. He should have been deeper. Okay? So now, the water line and the blood appear at the same exact time, right when that railroad track closes. That is the confirmation that you are a buyer. Count the levels. 1, 2, 3. Trade is over. See them? Okay. TDI is excellent at helping us identify our market maker pattern. So the rules for a shark fin long, same criteria as a short. Flip it upside down, hold it in the mirror. The setup's got to coincide with other indicators. Not MACD and CCI, the indicators I've been giving you since the first day of class. 25 to 50 pips higher, Asian range less than 50 pips. They cut the stops 25 to 50 pips lower, railroad tracks, inverted hammers, WM, and you've got to be in the right part of the cycle. If you see a shark fin in the middle of the run, something's going on, something different. If you see a shark fin and the trade doesn't show a profit in how long? Anybody? 2 hours. You squash the trade. I don't care what TDI says. Okay? That's how you use TDI. Now, what do we have? Okay, Steve, we got this pattern that you've been talking about since you got here. I'm actually sick of hearing about it. We got a TDI indicator. We got JAWS 3D where it makes a shark fin high, shark fin low. Sometimes there's even 2 fins. It gives you school of sharks. Pretty cool. Okay. We got pivot points, M3, M4 possible high, M1, M2 possible low. Now, we have the timing. The timing is sometime between 1 and 4 a.m., but preferably the last quarter of the blue box to about mid-session. These are the things I'm talking about that are coming together. These are a confluence. If all these things trigger, after Batman, MW, all these things coming together are there, back up the truck, man. Open the door and hire 4 armed guards. It's over. There it is, shark fin low. 1, 2, 3 to the low out of a 21 pip box. 3 waves inside of TDI. Notice that level 3 is divergent. Why is level 3 divergent? Because level 3 is aggressive. Level 1 and level 3 are aggressive moves to trick you in the business. So notice you got shark fin low, blood in the water. When that shark fin crosses back under the water and JAWS takes a nap underneath the ocean, you need to be in that trade. On this example, right when it crossed the bloodline, you were a little late. But listen, level 1, sideways, level 2. Then price actually makes another push to the high side. But TDI returns back inside the band. Why didn't you get out there? You can, it's okay. But you know how to count to 3. Shift 1, consolidate. Shift 2, consolidate. Shift 3, 2 pins to the top side. TDI is divergent. That's the exit, because there's 3 levels there of rise. I told you you were smarter than an indicator. It can only follow price and indicate. You have to know how to count to 3. There it is. Shark fin low, blood in the water, long. 21 pip channel. They cut the stop in 3 swipes to the low to trick us and show us short. They shift the zone in 1 bar, go into consolidation. Hit the stops high, hit the stops low, shift it again. Hit the stops high, hit the stops low, shift it again. TDI is divergent. 2 pins to the top side, exit the trade, stop yourself out, reverse the other way back into the range. For God's sake, it's more pips than you can handle in a week. Okay. Now, one of my favorites, shark fin, hold the Mayo. Here's what happens. The mayonnaise happens to be right around the midweek reversal, right where they make the move. There's actually 2 trades in there. This is what Rick has been doing. Rick will grab the first leg of the M or W right at the start of the session, right out of the box. Look at that, 1, 2, 3 to the low. Shark fin long, right? It happens to be holding by the mayonnaise. So maybe that's a sandwich. Shark fin, hold the Mayo. It runs right back up, higher than the high. Then it comes back and repeats the level right before the end of the session. What does it do? It's divergent. It slightly passes the mayonnaise to give you an idea that it's firing all the traders that think that's a trend change. But we know better. TDI is somewhat divergent. We have a shark fin that's under the water, so he's lurking under there. But you get the blood cross, and then all of a sudden you get the market baseline cross, and then again there's 3 levels inside the TDI before it goes into consolidation. And at level 3 again it happens to be divergent. Do you see how great that is at picking the setups? My grandmother could pick those. And she's dead. Okay, now, scaling in with TDI. I'd like you to learn to scale in close to the high and close to the low. That's better. But some of you are still learning, and I'm going to show you the opportunity to scale in with TDI. Okay?
If I told you the signals were a shark fin crossing the water, blood in the water, and market baseline, and a break outside the band, okay, don't get confused with the break outside the band. A break outside the band in the right context of the cycle. When it breaks outside the band during a stop line, you better not scale in. You're missing what I'm telling you. Okay? Here we go. You are in the right market segment. Write these down. Price is in the channel. What's the channel, Steve? It's not channel 7 on your cable dial. It is the Asian market maker spread range being set up. The RSI line breaks outside the bands as a stop hunt. The reversal, you know, is imminent. Look for the signals in the setup. What are the signals in the setup? I've been talking about since I got here. 25 to 50 pips lower, inverted hammer, WM, blah, 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 right? You enter the trade. The lazy guys use the stop loss of 23 pips above the high or below the low. I want you to use less than that, but I don't want you to get stopped out just because you're impatient. Add to that trade at a market baseline break. Steve, what's the market baseline again? The liquid gold moving line that moves around. And it's very appropriate that it's gold. On a volatility band break, you may add again in the right cycle of the market. Exit all units on a volatility band return or crossover. Unless you can see the levels more clearly, stay with it. Okay? This is the right way to use it. Here you go. This is a typical trade taken by, I think it was my wife, I don't remember. TDI volatility band break. Right? Look at it. Shark fin high. Shark fin high, hold the Mayo. Okay? Technically, it's a shark fin held by the 200 EMA. But I like shark fin, hold the Mayo. It's better. There is your work off of the high. There's your spinning top. There's your 2 pins right to the mayonnaise. Okay? TDI crossed back under the water. The shark went back under the water the same time he took a bite. Perfect signal. Take it. You're a seller. TDI crosses the market baseline. Maybe a bar or two before it crosses the mid fixed 50. That's okay. Perfect. TDI breaks outside the band and spikes to the low aggressively. Now you know you're going into the session. You could have one of two things. Tried to identify the levels, or you've been up all freaking night, go to bed. It's 400 pips. Okay? When it goes into consolidation, what do? Remember? Hit the stops, commence the next level. What happens is TDI came to rest and became divergent. When it crosses back inside the band and crosses the signal line, I know price still runs down, but you got to understand, you've been up from here to here. When are you ever going to sleep? If you're not happy with 400 pips overnight, I'm not your guy. You got to find somebody else. This is a nice signal setup. It's perfect. Comes right out of 28 pip channel, 3 swipes at the high. Shark fin high, hold the Mayo, scale, run, into consolidation, take your money and go to bed. If it's standard lots, it's $4,000. If it's an aggregate of orders, it could be $80,000. If it's mini lots, it could be $400, $1,200, depending on how you're scaling. But just understand that you don't need a lot of money when you know how to identify the top of a market and the end of a run and take your money. That is priceless. You can start with a $50 mini account and trade micros, and you could have it built up to $1 million by next Christmas. Okay, so TDI, here's the rules. TDI offers a few key points to scale in with. After the entry is made, you add to your trade on a market baseline cross. Gloria, what's the market baseline? The gold line. Why is that significant? Because I told you in the underlying indicator, the RSI, when it crosses the baseline, the 50, that is a shift in momentum in our favor. But the gold one doesn't wait for that. It goes up there and gets us and tells us, hey, dude, you got this now. Take it. When it breaks outside of the volatility band, you can add again. Not during the stop hunt. When it breaks out of the volatility band during the trend run. The right context of the market. Sometimes that thing will hang outside the band for the entire 3 levels. Sometimes it won't. The limitations of an indicator. Didn't I tell you that it'll spike and go sideways when price is running? That happens. That is the limitation of an indicator.
But you have no limitations because you have a brain. Exit all units on the volatility band return, or, I need to add this, level 3 is seen. Okay? If level 3 is identified, and it just so happens to coincide with the band return, get out. That is confirming that you got level 3. Another thing that needs to be on here is count the levels with TDI. If you can see 3 levels in TDI, and you see it in the price, and you're starting to get the spikes to the downside, get out. 180 pips is not enough for you. I can't help you without scale-ins. Okay, this was sent to me by my good friend Masood. This is one of the examples where TDI returning to the bands caught it like magic. And there's also 3 levels in there, okay? This is a 110, 168 pip run. Not bad for a guy that graduated from Harvard. Okay, here we go. 69 pips. Steve, the box is a little blown out. Yeah, it is. Redraw the bracket of consolidation. Bam, break to the high. We know that that's a trick. Okay? He took the trade right there. Shark fin high, back in the water. There's no blood yet. Scale. It pretty much got blood in the water about the same time it crossed the base. He added again. Level 1 is complete. Level 1 is complete. There's the pullback. It broke outside the band. Add to the trade. It pulled back but did not come back inside the band here. Level 1, level 2, level 3 is seen. It goes in. It is slightly divergent and starts showing the shift in the pins to the downside. That's the exit. Perfect. It nailed it. Okay? Now, what happened? Market makers came back and repeated the W. If you weren't in here, this is the exit or the signal to get back in for the next run. This is one of those that it's almost like TDI was like Nostradamus. It nailed it. Okay? Shark fin high, crosses back under the water, sell, crosses the market baseline, scale, breaks outside of the volatility band, scale, level 1, level 2, level 3. We are at level 3, erratic behavior is seen and expected. It crosses back inside, takes another bite out of somebody's leg, you get out in the consolidation zone. Not a bad day. I can't add, but somebody tell me 110, 100, 210 plus 68. What is it, 278? That's not a bad day. TDI identified it perfectly. Okay? Perfectly. Here it is again. All the things coming together. 3 swipes to the low, shark fin low, hold the male. It is held by the mayonnaise. The consolidation is seen on the mayonnaise. It just so happens to coincide with a pivot point. You got some mayonnaise, a pivot, and you got 3 swipes to the low, right to it. Perfect. Shark fin low, breaks back inside the water, takes a bite out of the leg right about the same time. There's blood in the water. Enter. Crosses the market baseline right around here. Enter. It breaks outside right before the trend starts running away. Level 1, level 2. Now, here's the tricky part. First of all, you've been up for 12, 15 hours. It returns back inside. It's divergent. This is the limitation of the indicator. It is running sideways while price is running away. You know and expect level 3. Okay? If this is not enough for you, try to identify the levels. To level 3, look for the pins, look for the M formation around or near the red box. That is a better signal. Okay? Again, railroad tracks. No shark fin. Why? There's a shark fin there, but it's contained by the band. Why? Because market makers didn't go 25 to 50 pips below the blue box in this example. They just threw railroad tracks right at the open, just enough to trigger the stops or the pendings on the other side of the Asian range. As soon as you see those railroad tracks in line with the overall market maker trend, take the trade. It breaks outside within a few bars outside the volatility band, and again, TDI happens to nail the consolidation. And if you notice something really crazy about that trade, there's no drawdown. It's solid green to the high. Solid green to the high. Show me one red candle in that aggregate. It's amazing. You caught that trade at the low of the day within a few pips, your stop loss was below the railroad tracks, and you had a nice 2-hour straight rise. Pretty cool. Okay. Here it is. A typical run where TDI nailed it again. 30 pip channel, market makers trade slightly above, they throw the pin, needle top side. Shark fin, see the divergence? The shark fin on the very left inside the range is outside the volatility band. The second one is inside the band. The divergence is contained by the bands. Why? Volatility is calmer, less money after they spike. Now you get the cross, blood in the water, back underneath. Well, he stayed under the water the whole time, sorry. Add to your trade. Level 1 consolidation, half a Batman, add to your trade. It breaks outside of the band, it takes a run, it's gone. It runs for the entire session. There's your outside pin to the low, back into consolidation. TDI picks it up, shark fins back inside, takes a bite out of somebody's leg, trades over, go to bed. Or look for the reversal back into the range. There's another run by TDI back to the 50. See it? There also happens to be 3 waves inside the green TDI line to give you level 1, level 2, and level 3. Level 3 being the longest run. Not too shabby. Okay, what do you got? Look at this chart. Market makers come out, hit the stops high, trap, shift. Hit the stops, drop. Hit the stops, drop. Start turning the pins the other way. They were going to put the brakes on right here, but what happened? They looked at it for about 45 minutes. They didn't have what they needed. They hit it again. There's the outside bar to the low. They pull away, pins low, pins low, pins low, pins low. Hit the stops, erratic behavior, sideways movement. This is a reversal all day and twice on Sunday and twice today. There's the railroad track, second leg. You can enter there. There's your trade back into the range. 25, 30, 50 pips, depending on the pair. TDI caught it here when it went into consolidation. Okay. Here's an exercise and here's homework. Do me a favor. I want you to do this homework. But I don't want to get my inbox bombarded. My email is totally messed up. You guys destroyed it. I think it's pretty cool. Never had it happen to me. My inbox quit working. My outbox quit working. I don't know how that even happens. I have all the emails that I answered you. I showed you the picture. I called some of your names out. Lined up in queue, it won't go out. I've never had that happen before. I'm not getting any more emails. My wife tried to email me and it bounced. So I have to fix that somehow, and I'll work on that. But here's what I want you to do. Enjoy the holiday. Mark up some of these charts. Go back and do all the homework. Use TDI in the context of our market maker pattern. Okay? Put those signals in line with what I'm teaching you here. And then mark it up and mail it to me next week. I don't know. What's next week? Christmas? Mail it to me after Christmas. How about between Christmas and New Year's? All right, mail it to me between Christmas and New Year's. By then, I should be recovered from screaming at you guys for 4 days, and I should start looking at some email again. I could tell you that after I leave here tonight, I'm going dark. You ain't going to hear from me at all. Okay? I had plans. They've been altered, and I want to pick up and, I guess, fulfill my commitments, my obligations to my family that I made. And so I am going to go completely dark. You won't hear from me. So don't send me an email because it's just going to bounce probably. So after we're done here, I want you to take some time, absorb this, breathe, take a breath. Then I want you to go back and I want you to identify these signals that I just went over using the TDI. Okay? There's no one better to ask than Dean, so if you guys hold a session, ask Dean. Dean, sorry, I just dumped everybody on you. Mark your charts for review and discussion. I want to see if you're getting it. Okay? Previous high-low marker. All right, you know what? I don't know if you guys need a break. Do we? We need a break? Let's see. I talk too much, don't I? Jeez. Yeah, I went long. Let's take another 10. And let's take 10 minutes, grab something.